There still are concerns about COVID. There still are concerns about geopolitics, and there still are concerns about whether the long-term growth prospects remain.
We're still optimistic that the disinflation story takes hold and goods prices don't have to rebound sharply.
The US consumer has begun quite a considerable divestment phase.
The impact of a year of very aggressive central bank tightening and quantitative tightening are starting to bite the economy, and they're biting hard.
Would just expect that the Fed's hiking for longer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a brilliant week of conversation. Bob Michael at JP Morgan, just absolutely tremendous yesterday, Tom. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Equity futures down by about 0.5%. Two big takeaways in the last 24 hours, Tom. Number one, bad news is just bad news. And two, bonds did what bonds are meant to do. Did you see that rally yesterday?
Yes, it is whiplash, whipsaw, whatever you want to call it. My head is spinning over this shift from whatever you're talking about. Is it good news or bad news? We're making jokes about it, but it's hugely tangible after the data yesterday.
Our next guest in just a moment will tell us the mood has been following the price action. Here's the mood right now this morning. Following the biggest one-day decline of the year so far on the S&P. This from Julian Emanuel of Evercore, Tom. The market's New Year rally has concluded. He went on to say, and while economic surprises have increasingly occurred to the downside, the deterioration is unfolding against the backdrop of the fact that no bear market has ever bottomed before the start of a recession. The latest from Evercore this morning.
We hope you stay with us this morning on television and radio, because John and I are going to do this, and we're going to do this off the fixed income market, which is if you're in stocks, that's what you observe. And John, I'm sorry, the 2-year yield today is a textbook case of, boy, if you're in equities, watch the 2-year.
Two's very close to breaking 4%, 4.06% right now. The whole curve has dropped in the last couple of days, Tom. So the 10-year peaked intraday last year in October at about 433, 434. We're about 100 basis points south of that right now on a 10-year. That has been a big move lower in the last couple of months.
We're a family channel, so we don't do technical analysis, but it is a textbook lower yield chart. The 2-year yield from early November, right near the election, has moved from 4.72% down to, call it, 4.07%. And this is how you make money in bonds. We never talk about this in financial media, John, is the price change. And the answer is, if you bought the 2-year yield in early November, you've made a 5% capital gain plus your coupon along the way. That's how money's minted in fixed income.
Big move. If you want the day ahead, jobless claims coming up at 8:30 Eastern Time. And look out for some Fed speakers. We hear from Vice Chair Brainerd today and Williams of New York. So two core Fed speakers down in D.C.
I 100% agree with you that we have a cumulative speech from the vice chairman. She is leaned on Wesleyan economics and truly an interesting and distinctive monetary theorist. And Williams owns the high ground on our start. And that's a big debate now, is trying to game this inflation unemployment metric with where output is. And that's John Williams front and center. Bill Dudley, I believe, is scheduled to be with us as well.
Looking forward to that a little bit later this morning. Good morning to you all. If you are just tuning in, equity futures breaking down just a little bit. We're down 0.6% on the S&P 500. Yesterday, the biggest one-day drop on the S&P since the December 15th Fed meeting, I think, the middle of December, or shortly there afterwards. So equity futures just a little lighter. Softer, negative. Yields come in just a little bit, 336.78. Big rally in yesterday's session. Twos all the way out to 30s. In the FX market, euro dollar 108.29, positive 1/3%. Some hawkish ECB speak this morning. Christine Lagarde, inflation is way too high. That's the ECB president. Klaas Knot of the Netherlands, Tom. We're only focused on the risk of doing too little right now. We've discussed that a million times. What's the biggest risk, doing too little or doing too much? They're telling you it's the former and not the latter.
I spent quality time with Mr. Knot of the Netherlands. I believe it was at the IMF meeting. This is a name that Americans don't know, and it's a name to become familiar with. I was most impressed by the rigor of his economics.
The Hawks make a continued push. We can catch up with Greg Battle now, the US head of equity and derivative strategy over at BNP Paribas. Greg Battle, we've got to lead with this. 3,400 on the S&P. Year-end is your price target. You're not looking for that dip and rip. You're just looking for a dip. Year-end on the S&P. You are the most bearish strategist on the street right now that we track. So, Greg, let's start there. Talk to me about the journey to 3,400.
Yeah, good morning. Well, I think the target itself is less of an outlier than it seems, because when you look through the forecast that many strategists have for the first half of this year, similar to us, people are looking for recessionary price action and for the equity market to make new lows. Where our view is a little bit differentiated is we're not looking for the type of V-shaped recovery that we saw back in 2020. We think there's going to be a harder environment to see fiscal and monetary response, and we think that leads us to an equity market that can have some healthy declines this year.
The BNP Paribas hallmark here is to undershoot GDP. You've always been right about that. You've never gone with the boom crew, if you will, Greg, and that all devolves down to the x-axis, the timeline. Give us the timeline of this equity weakness. Is it 1 quarter? Is it quarters? Or really, can you get out into the depths of 2024?
Well, I mean, obviously, we've seen some pretty big declines in the last calendar year. That was far more of a story of multiple compression than it was recessionary price action.
Right.
What we're looking for in the first half this year is recessionary price action. We think that can start with this current earnings season. We've seen some bad economic data this week. We've seen Alcoa after the bell yesterday, which was a little bit of a troubling release. And we think this earnings season over the next couple of weeks could be a challenge. But really, when we fast forward 3 months to Q1 earnings season, we think that could be really the point at which the economic data is really decelerating, and we could see some real capitulation in terms of earnings forecasts. So the next 2 earnings season, we think, could be the most troubling for equities.
What is this placement of bets right now? When you look at the cross moments around the equity market, and particularly skew, when you look at the fancy derivative chat, what does it say about the bet that's being placed right now?
Well, I think what we see in the equity vol market is a little bit of a reflection of what we've seen more broadly in the equity market, which is a more constructive start to the year. We saw the VIX trade down to an 18 handle, which is kind of very low relative to where it's been over the last year. And that's really reflective of this kind of China reopening, warmer winter in Europe, starting to translate into some short covering into the US, which people are starting to weave into a narrative of maybe this elusive soft landing is coming. But we think that's pretty inconsistent with the data. I mean, when we look at the data this week, retail sales, industrial production, empire manufacturing. This is data that's decelerating aggressively. So we think there's some signs of complacency, and I think the VIX sub 20 has been a pretty bad signal for the equity market over the past year.
There is a bit of pushback against this view. It comes from Neil Dutter of Renaissance Macro. We caught up with him a little bit earlier this week. Just listen to what he had to say, Greg. The manufacturing data, undeniably weak. You mentioned the IP data yesterday, but why does this continue, he asks. Aircraft and autos have a lot of momentum. The dollar's sold off, supporting the exports of manufactured goods, and global growth has rebounded. Neil is pushing this idea that we could have a more resilient economy than some people expect, Greg. What would you say to that?
I think we've had an incredibly aggressive tightening cycle from the Fed, and we know these things act with these kind of long and variable lags, as they say, and I think we're going to just bite some of the pain this year. So Carl Riccadonna, our economics team, point to the idea of nominal GDP falling below Fed funds as something that historically has really been a signal for deceleration in terms of economic momentum. They expect that to happen at the start of the second quarter, just when Q1 earnings are being delivered. When we look at things from a more bottom-up perspective, there's undoubtedly been a real deceleration in terms of earnings forecast momentum. We've seen it sequentially, that each earnings season has seen downgrades a little larger than the last. We think we're going to get bigger downgrades as we move through the next couple of weeks this earnings season, and we think we get bigger downgrades than that as we move through Q1 earnings. So I think the outlook is challenging.
Greg, how important is history here as well? We mentioned Julian Emanuel of Evercore a little bit earlier this morning when he said this line here: no bear market has ever bottomed before the start of a recession. Does that weigh on you too?
Yeah, absolutely. I think that's a great stat. We produced a piece where we went back and looked at every recession and bear market over the last 100 years, and that was indeed one of the takeaways that we've seen. When we look at recessionary bear markets, and we do think we have a recession this year, they tend to be deep and they tend to be very long. We've gone back and studied all of these crashes. We see some notable similarities between where we are today and where we were in the early 2000s. That was a bull market that was driven very much by multiple compression, retail participation, tech and growth stocks led. Very similar to the bull market we experienced prior to last year. And that unwind was long, it was deep, and we see a lot of similarities of that to where we are today.
Greg, your shop has an absolutely original heritage in China, folks. This goes back well into the 19th century. BNP Paribas and China Can their boom, can their predicted boom, can their end of COVID, can their new 5 or 6% GDP growth, can that overcome the equity gloom?
Well, I think we've obviously seen the power of the reopening trade in the US, and that's certainly been the driver this year of this more constructive start for equity markets globally. I think that we would question a little bit about whether that's going to be sufficient alone to offset some of the headwinds that we see here domestically in the US, but it certainly raises the question of relative performance globally in equities. And this is one of the reasons why I'm more comfortable with this bearish view for US equities, in that in the case that we're wrong on the global macroeconomic outlook and global growth is stronger, we think there are regions other than the US that are likely to lead that charge higher.
3,400 on the S&P 500 year end is the call. Greg Battle of BNP Paribas. Greg, thank you, sir. Thank you very much. Reminds me of that quote from Mike Wilson of Morgan Stanley this week, Tom. Bear markets are a hall of mirrors designed to confuse investors and take their money. Is that the last couple of weeks?
Yeah, I'm not going to have an opinion on this, and I'm in triple leveraged all cash, so I don't have to have an opinion. But what I would go to is Ben Laidler's observation of multiple bear market rallies, and you become used to that: up, pull back, until you don't. And the question is, what are the set of circumstances where all of a sudden it becomes a bull market? And John, I would suggest there's not that many people calling for a quote-unquote bull market. Some people are away from the gloom that we just heard from Mr. Battle.
I think the tug of war continues, and I don't think that tug of war has changed. And that tug of war, if I could frame it as follows, looks like this. Those on the one side who believe we're about to pay the price for a year's worth of monetary policy tightening, and those on the other side who are pricing in a recovery off the back of China reopening. That's kind of been the story of the year so far. And I think the problem a lot of people have sitting at home is they're like, what's changed? What's changed in the last couple of weeks apart from the fact that we had a rally and people want other people to get on board with that rally? And what's changed in the last 24 hours apart from the fact that we had a sell-off? And I think the range has changed too much, Tom, looking at, say, the S&P 500.
And the confusion on the data of hard data versus soft data. We'll talk about this through the morning as well, and it is an important Data Thursday.
Well, I'll tell you something that has changed, and that's just that breakdown in bond yields, and that just continues.
Yeah, that's front and center.
Yeah, without a doubt. Without a doubt. 2-year yields just north of 4%. Your 10-year, at the moment, unchanged on the session, 337. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A surprise announcement in New Zealand. Prime Minister Jacinda Ardern is stepping down before a general election later this year. She says she doesn't have the energy or inspiration to seek re-election in October. Ardern is 42. She became the world's youngest female leader when she led the Labour Party to power in 2017. Strikes coordinated by French unions look to bring much of the country to a standstill today. It's a protest against government plans to revamp the pension system and a test of President Emmanuel Macron's ability to resist street pressure. Workers in railways, schools, hospitals, and air traffic control are among those taking part. Ukraine's President Volodymyr Zelensky is once again calling on allies like the U.S. and Germany for tanks, artillery, and longer-range missiles. Zelensky spoke on a video link to the World Economic Forum in Davos. He said the additional weapons will be used to target Russian forces occupying parts of Ukraine and not inside Russia itself. Two Federal Reserve policymakers favor a downshift to quarter-point interest rate hikes. Dallas Fed President Lori Logan and Philadelphia Fed Chief Patrick Harker laid out the case for smaller rate increases. Now, that came after data showed inflation at the wholesale level declined. Bloomberg's learned that crypto's Genesis Global Capital may file for bankruptcy as early as this week. The cryptocurrency lending unit of Digital Currency Group has been in talks with various creditor groups amid a liquidity crunch. It's warned that it may need to file for bankruptcy if it fails to raise the cash. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Following the biggest one-day drop on the S&P 500 of the year so far, going back to the middle of December, we add to those losses this morning. Equity futures down by about 0.5%. We're down 0.6% on the S&P 500. The bond market, all attention on jobless claims, 8:30 Eastern Time. Then we get some Fed speak a little bit later. Vice Chair Brainerd, New York Fed President, Mr. Williams coming up as well, so look out for that. Just look at this, though, 336.96 on a US 10-year. We are down almost 100 basis points from the intraday highs of October, Tom. And I said it earlier, bad news is bad news. That drove the equity market lower yesterday. And bonds did what they're supposed to do. They rallied in the face of that.
Yeah, there's been a shift here. Ben Emmons mentions it this morning, talking about the shift from the 9 days of exuberance to where we are now. But, John, can we agree at 407 on the 2-year short-term paper, and maybe what the Fed cares more about, that a 3.99 print is a big deal for this week?
Oh, three-handle, without a doubt, Tom, because this Federal Reserve at the moment is, yes, having this conversation about 25 or 50, but ultimately still pushing towards 5, a 5-handle on Fed funds. And Tom telling us that when they get there, they want to stay there for a while. I think it was Neil Kashkari who said that's the second phase. That's the next phase of what we're trying to achieve here. It's not just get to 5 and then start cutting. It's get to 5 and then wait there and be absolutely certain that this inflationary story is over.
Well, we'll have to see. And I think we'll see. And again, I'm completely data dependent on this. And as John mentioned, for those keeping score, the hard data yesterday was sporting and led to the decline we've seen. And again, we see it. Dow futures negative 200 right now. I think that adds up to, John, negative 600. I think we are negative 700 here just over the last couple of days. For those that follow the Dow Jones Industrial. Do you know that 82%? What are you doing? Do you know that 82% of Davos attendees follow the Dow Jones?
They follow the Dow. Are you saying
they're all fossils?
Are you saying it's an elitist index?
No, it's an ancient. The average age in Happy Valley is like 74, and they all follow the Dow.
I think we both agree on the Dow.
Yeah.
There's no separation.
Bono shows up and the needle skews the other way. Joining us now in Washington, she's listened to all of you too. Anne-Marie Horton joins us, our Bloomberg Washington correspondent. Anne-Marie, I want to go to something 3 days ago, and this is your immense skill, which is you go to a story and 3 days later you're read in on this. Brief us now on a bipartisan Congress that hates China, and yet Secretary Yellen is in the process of a U.S.-China thaw. 3 days on from that shock, how can you interpret that?
Well, I think even if you have lawmakers that want to throw stones and create legislation or committees that are going to look into and combat China in terms of whether it's trade, human rights, or Taiwan, the U.S. is still going to have a relationship. These are the two biggest economies in the world. We also should really caveat Secretary Yellen's sit down with Liu Hu, the Chinese vice premier, because he is on his way out. As Doug Redeker put it to me yesterday, he's really a lame duck. But what this does do is it just opens a pathway for communication. And really what is key to her sit down in Zurich is the fact that it came before her tour of Africa, and she's going to go to these countries that really have big issues when it comes to debt that China owns. And this is something the U.S. is focused on, debt sustainability of these countries and all the inroads China has made in these countries with Belt and Road. So I wouldn't read too much into their sit down as it being a huge thawing of relations, but they're talking again. Remember how dire the situation was between these two countries in terms of diplomacy after Speaker Pelosi went to Taiwan. I mean, we had a missile end up in Japan's economic exclusion zone. Okay, so now you have the Secretary of Treasury speaking to her counterpart. By the way, we need to mention he's on his way out. Then we have Secretary Blinken headed to Beijing as well. The policies have not changed. Nothing has changed, but they're talking.
They're talking, and they have to move forward to some form of bilateral or multilateral approach. Are we on the edge of multilateral in America? I don't sense that with the animosity of Congress towards getting anything done.
Well, no. I mean, when China, maybe you can see something get done. We did see Congress ban TikTok on all government-used phones, right? That is a step of Congress
we need to be clear here.
Together.
Anne-Marie, we need to be clear here for the adoring horde of Bloomberg surveillance. Is Anne-Marie Horton still on TikTok?
I am not on. Still, no, I never was. I never was on TikTok. Didn't get into the fad, and then. You have to look into the analytics behind TikTok in terms of potentially what could be pushed out to users who use it. This is a big concern amongst lawmakers because of the fact that so many young Americans actually get their news from TikTok. So maybe they clip, a segment, Tom, of you talking about something wonky they want to learn about, and in those 15, 20 seconds on TikTok, they learn about it searching something for Bloomberg. But all kidding aside, there are inroads into bipartisanship on the Hill when it comes to places like China.
Just want to turn to Senator Manchin and get away from TikTok for a moment. Can I do that? I think I can do that. He spoke to Fox Business over in Davos, Switzerland, Anne-Marie. He said he wants to deal with the Republicans on the debt ceiling. Can you walk me through how this is going to work out and how important that voice might be this year compared to how important it was in the last couple of years?
Well, he's still an important voice, but he's not as important as he was maybe the prior 2 years of the Biden administration, right? Everyone called him President Manchin because they needed his vote, and he was usually this one that was sometimes difficult to get on board. We saw that, of course, with a lot of legislation the administration was trying to get forward. What he's talking about here is maybe setting up a committee to look into the U.S. debt and to work in a bipartisan way, and how they can also make sure that things like Social Security do not become insolvent. But the issue they have here is that the administration and Democrats, for the most part, are not going to negotiate spending cuts when it comes to the debt ceiling. They truly see these two issues as separate paths, and they do not want to negotiate. But Senator Manchin looks open to maybe this Senator Romney idea of setting up a committee to look into this. But this is going to be a really difficult fight. I know I say that and the markets are shrugging it off, and it is very early right now. Of course, we're going to have the Treasury going into the special accounting measures. But in the summer, this is going to come to a huge fight between the Republicans and the Democrats, and it's a divided Congress. And really the worry is that this becomes to the brink so much that we could, I'm not going to say default, but potentially another downgrade like 2011.
The key word there, early. It's too early. TK, I get the same response from everybody I speak to about this on Wall Street. The investment community is just like, here we go again. It's too early for me to care about.
Here we go again to me is
too early for me to care about.
Yeah.
And ultimately, they will obviously care a little bit more as we
We're
get
going to
closer
dive
and
into
closer
this
to
in the next
summer.
hour. Surveillance exclusive, the debt ceiling.
We'll dive into it a little bit more in about 4 months.
Yeah, that's where I am. I totally agree. We're way ahead on this, but the fact is it's percolating, and we've got some smart discussion coming up.
AMH, down in Washington. Anne-Marie, thank you. As always, thank you very much. That smart discussion with
TikTok?
Mr. Dudley.
I mean, this is serious,
right?
folks. I want to hear from you. I just did TikTok Joe Manchin is a search. I mean, Stephanie Rule comes up and every other news media type. And
they're all on TikTok,
John, are we missing something? You and me on TokTik? I think it'd be great.
On Top Tick.
Top Tick, yeah.
Top Tick, I think, is something else.
The tots are on TikTok.
I can tell you this, from what I understand, the version that they get in China is very different to the version that we get in the United States, particularly for young people and how they consume a lot of the information on that app, Tom. And you said something earlier, and I want to clarify it. It's not that Washington, D.C. hates China. It's that much of Washington, D.C. hates the policies coming out of the Chinese Communist Party. And I think that's an important distinction, TK.
Yeah, it is. This goes back, of course, to World War II and the formation of the communist society within the powers of China as well. And there's a lot of ghosts here that go back. And, I had the privilege of living some of that, not only on Formosa, becoming Taiwan, but just there's a lot of nuances here that I think a more modern dialogue misses that leads to that bipartisan angst.
Yeah, I would go further as well. I think there's a frustration with multinationals, particularly in the West, and a degree of hypocrisy, who have one view on things that take place at home and another that take place in other regions.
Anne-Marie led, they got to get business done.
Yeah. Futures right now on the S&P, we're down by about 0.7% on the S&P 500. The sell-off over the last couple of days continues. Couple of hours away from economic data in America. Jobless claims coming up a little bit later this morning. Good morning to you. Equity futures on the S&P and the Nasdaq shaping up as follows. On the S&P, we are negative 0.75%. Looking at session lows now. On the Nasdaq, we're down about 8 or 9 tenths of 1%. The Nasdaq yesterday snapped a 7-day winning streak believe it or not, the longest going all the way back to 2021. So a little softer this morning off the back of some weak data in the past 24 hours. Will that be confirmed by jobless claims a little bit later? In the bond market, 2s, 10s, 30s. In the Treasury market, look a little something like this on a 2-year, just north of 4%, 4.078% on a 2-year. After coming very, very close intraday to 480 in the last few months, we've backed all the way away from those levels. On a 10-year, 433, 434, the intraday highs of the last 12 months. That was back in October. We're now at 337.51. Big move lower yesterday on a 10-year yield at the close by 18 basis points, Tom. 18 basis points lower on a 10-year yesterday.
We're focused on bonds here, and of course, curve inversion really hasn't happened. It's been very static. But what I would suggest, John, is the pullback yesterday, the tension from that economic data is seen in equities, in bonds, in commodities. It's very evenly distributed, which maybe can be a good feeling for a lack of panic.
Finally, things were quite intuitive. I've said this a few times already this morning. The data was bad. The market response to that was bad too. Equities lower. And the second point I'd make is that bonds behaved in the way that you'd expect bonds to behave. In a market like that one, bonds rallied, yields dropped. Will that continue? I want to finish on foreign exchange and euro-dollar. Euro-dollar, all week, we've had this story about will they go 25 in the next couple of months? Will they drop away from 50 after hiking 50 next month? We heard from the French central bank governor over in Davos, Switzerland, that number could well be 50 for the time being, pushing back against that. ECB President Christine Lagarde, it was her own guidance that said 50 basis points, and maybe keep going 50 basis points. Lagarde spoke a little bit earlier this morning, saying inflation is way too high. 2023 won't be brilliant, but better than feared. And ultimately, I think Klaus Knott, picking up on the big story for me at least over the last couple of months, what's the biggest risk here? The risk of doing too little or the risk of doing too much? And does the risk of doing too little outweigh the risk of doing too much? And the Fed, several months ago, said it was all about the risk of doing too little, outweighing the risk of doing too much. What do you hear from Klaus Knott of the Netherlands, Tom? Exactly that same argument over at the ECB.
Right.
The ECB is only focused on the risk of doing too little right now.
Well, that's the politics there of not having a unified fiscal policy. What I would suggest, John, is to me the great attribute here, moving from Japan, highly troubled, to Europe with a war, to the United States, is the animal spirit of the three economies is starkly different. I'm going to give Europe credit for improving their nominal GDP trend. Japan is hugely problematic on a top-line GDP basis. And, of course, the U.S. leading the way. Is that going to shift this year? I don't think so. And Christine Lagarde, in a fractious ECB, her major constraint is just the economic might of 17 nations or 20 whatever nations, depending on if you want to count Croatia.
On Europe, we started this week, Tom, and we said there's a big difference between good, bad, and better or worse.
I miss Bramo. She'd be right on
No, I think this is really important, Tom. Lagarde said this morning that the news has become better, much more positive, that we could see only a small contraction. She said it won't be brilliant, but it will be better than feared. And I think we need to be really, really clear about this. The story we're talking about in Europe is not a good one. It's just a better one than feared. And that's what ultimately matters to markets, Tom, and I think that's what we've been traded on over the last couple of weeks.
Well, the bad news, good news thing, I'm not going to go there. I think it's just a bunch of, media baloney. But I will say it is being written in the strategy notes. And Ben Emmons over at Newgate, Ben Emmons makes real clear on disinflation, John, there's been a shift, as you described yesterday, in the markets. And we have shifted on disinflation for more difficult economic data is bad news and moves that disinflationary bet. What does that do to the dots? Are there ECB dots? Can you imagine that?
Would you like to see that? I think we could guess which dot belongs to which country.
Yeah, exactly. Put little flags. Do flags.
We'll do a German flag for the Bundesbank, and it'll be somewhere at the top.
5, 6, 8%.
This is a great idea. This will work out, no doubt. Equities this morning right now down 0.75% on the S&P. More Fed speak through the week, including today. Vice Chair Brainerd and Williams of New York coming up a little bit later. Earlier this week, Philadelphia Fed President Patrick Harker repeating his support for a quarter-point hike.
The days of us raising them 75 basis points at a time have surely passed. In my view, hikes of 25 basis points will be appropriate going forward.
Diana Amoa of Kirkus World Capital Partners echoing Harker, writing the following. We expect the Fed to deliver 25 basis point hikes in February, March and May for a peak Fed funds rate, Tom, through 5%, 5 to 5.25.
This is an important voice, particularly on burgeoning EM and the enthusiasm for international that once again we see. We'll see how that works out. And we speak to Diana Moa of Kirkoswald Capital this morning. Is Jerome Powell central banker to your emerging market world, Diana?
He was definitely central banker to the whole world last year. I think now we're starting to see more dispersion in the data, in the economic outcomes. That means whilst he's going to be key for markets to get right, I actually think this year one can focus on individual stories in emerging market and actually look for opportunities that can decouple from what the Fed is doing. So still someone important and pivotal for emerging markets, for global fixed income, but less so than last year.
Which Pacific Rim emerging market is most emerging in 2023?
Well, the most obvious one is China, right? China was a mess last year. We had the rest of the world reopening post-COVID and China being very behind the curve. I think this year they are emerging from COVID. So indeed, it is the most emerging, but also from an impact to the rest of the world and to the rest of emerging markets. I think China is quite pivotal. So that's the one we're watching. That's what we're focused on this year, that will allow EM to possibly outperform developed markets.
Within that is a currency bet as well. Let's go to China, though, here on GDP. That seems to be what surveillance has looked at the first 9-10 business days of the year. Can you model out 5% GDP on China, real GDP? Can they get back to a pre-COVID level, or is a new lower level on a demographically challenged China?
Do you know what, Tom? If we'd had this conversation even 3 months ago, I would have said 5% is quite aspirational for China. But what we've seen is actually two things, which I think are very important, and markets need to actually recognize this nuance. The first is the speed of the reopening for China. They basically went from 0 to 100. You know, you've gone from zero COVID to no COVID in China, right? And so the dip in activity that we saw in other economies when they were reopening, when you had a pickup in infection rates, is likely to actually play out much faster from China. Add to this the fact that they're facing much less fatal strains of COVID relative to the rest of the world when it reopens. So we're seeing activity actually picking up much faster. The shorter term data that we track, so mobility indices, whether you're looking at subway utilization, traffic on the streets, is actually bouncing back pretty fast. So again, China is going to be a big headwind for growth to emerging markets, and it'll be quite positive to global GDP. The second thing that I think markets perhaps are not overly focused on is we've seen a complete turnaround. Before, China was focused on high tech, domestic consumption, etc. Now they're really focused or refocusing on the real estate market. And so we're going back to a version of the old school growth model, which is very supportive for GDP across the globe. But it's also easier for the economy to push that fiscal stimulus in. So 5% is not necessarily aspirational. I think if they carry on with this, we're seeing easing in some of the regulation, we're seeing pushing of financing into the real estate space. 5% is very realistic for China, and actually there's probably upside risks to that.
Diana, how inflationary do you expect this reopening to be?
So that's the wild card, right? You've just had one of the largest consumer of commodities in the world that has been shut down for 3 years, reopening. There is a high probability that you might see increased demand, whether it's in energy, which could, at the end of the day, derail some of the tailwinds we've been getting from an inflation perspective from weaker commodity prices. But we're also penciling in slower GDP growth in places like the US, and we're actually starting to see the data showing that the US economy is slowing down. So you may have a bit of give and take from aggregate global demand of commodity prices, which will be able to anchor inflation expectations. And then on the plus side, you have supply chains completely starting to reopen again, which will also be another positive tailwind. So the inflationary impact is one that you should definitely be watching to see how things play out. But I'd say the initial knee-jerk reaction of this is inflationary for the world is not necessarily that clear-cut.
Dana, over the last couple of years, we've explored how investable China actually is. In fact, I remember last spring, people were saying China is uninvestable. those reasons are still out there. So I just wonder, what's the best way, the optimal way of getting exposure to this story without perhaps going directly into Chinese markets?
Yeah, so that, from our perspective, that view hasn't changed. I think it's positive to see some sort of rapprochement towards the US from China, which may ease some of the tensions markets have experienced the last few years. But I think, the genie is out of the bottle, John. Once you've shown that you can pivot from a regulatory perspective at a whim, it makes it very harder for investors to come up with base case scenarios. So whilst we're very positive from an aggregate EM perspective on China reopening, we think there are better ways to express it than directly into China. So we're looking at places that might benefit either from an export perspective, so big commodity exporters such as Chile, I think will be looking to benefit from this. And I think that's one place where we're quite constructive on the outlook for the currency going forward. Or even places like Thailand that will benefit from a tourism perspective. So close to 40% of tourism into Thailand comes from China. And so we're starting to see those numbers picking up again. And we expect that to be actually a net beneficiary of the China reopening theme going forward.
The third year of pandemic economics. We're doing it all over again in this time with China.
Yeah.
Isn't it amazing?
Yeah, we haven't talked enough about that. It's getting long.
Well, we've got the rest of the year to do it, I can tell you that.
Yeah.
Diana, thank you. As always, Diana Amoa there of Kirkoswald Capital Partners. Really thoughtful stuff, Tom, about how you should get exposure to this story directly in China or outside of it, places like Chile, Thailand, etc.
All of us, and I can lead the charge on this, we've gotten lazy, and EM has just been pushed aside. Thank God for Damien Sassower. I wouldn't know where Indonesia was unless Damien was reminding me every 3 weeks. I think it's a reason for some surveillance road trips here to penetrate.
Yeah, I just think, Tom, over
markets.
the last decade, the focus has been where the outperformance was, and that was US large cap stocks.
US large cap stocks. And we're trying to get to a new world.
Make the argument that we are going into this new world after they've made that argument repeatedly and been wrong, but they right this time around.
You and I could go out. We could do the show.
You want to do an EM tour?
We could do the show from Batavia.
I'll talk a little bit more about that in a moment. I've always had a great idea for you and I, like a food tour.
Oh, a food tour.
Yeah, like a food tour.
This is like what you do with Manus Cranny.
Food/travel tour.
Like
Manus can come with us if he wants.
When you get off the train in London and you go north on that road to the Tots Stadium, you do the bar tour going up the road.
That's different. That's a bar crawl. No, we're not doing that. We're not doing a pub crawl. We do something else. With food. You go to restaurants.
I like it.
It's very original.
What were we talking about? What was the spicy thing we were talking about 6 months ago?
We'll talk about that in a moment. Bill Dudley coming up, 7:30 Eastern Time. It's 6:42 in New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The world's first youngest female leader is stepping down. In a shocking move, New Zealand Prime Minister Jacinda Ardern says she will resign ahead of general election in October. Ardern told reporters she doesn't have the energy needed for a third term in office. The Labour caucus will vote on a new leader January 22nd. The U.S. is adding another more powerful weapon system to a military aid package for Ukraine. Bloomberg's learned that about 100 Stryker armored vehicles will be included in a $2.5 billion package. It will be unveiled as part of a broader announcement by Western allies of new hardware for Ukraine, and that's set for Friday. In the UK, almost 500,000 workers are set to walk off their jobs on February 1st. Unions representing civil servants, teachers, university staff, and train drivers will take part. They're demanding higher pay to cope with the worst inflation in decades. Workers in the UK began mass walkouts in November. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
China is transitioning. China is already deploying a massive amount of renewables. They're the largest producer of renewables in the world. What we need to do is get less coal and begin to move away from coal that's unabated. Coal that is not reducing the emissions is the greatest challenge right now on the planet.
As John Kerry, the US Special Climate envoy from New York City. Hello. Jobless claims coming up a little bit later. Hello's a bit different to this morning, isn't it, Tom? Just, welcome people outside the United States who are not experiencing a morning.
And you said it in a soft, posh kind of voice.
Posh.
It was very good. You sounded very posh there.
You think you're the only person that thinks I sound posh?
Well, that's because I don't know. I can't tell the
No one in England
accents
would accuse me of that. Equity futures right now on the S&P, negative 0.75% in the bond market. What a move we've seen. Lower, aggressively so yesterday. Big move lower, down 18 basis points on a 10-year. Right now, up a basis point, 338.42. We're looking at jobless claims a little bit later. And I have to say, of all the Fed speak, Vice Chair Brainerd on deck later. That is really, really important alongside the New York Fed President, John Williams.
No, I totally agree. And again, we have to frame this out as different and eclectic. I really give the Fed credit for an eclectic group of academics that become governors and presidents and vice chairmen, but there's some that are monetary horses. Richard Clarda, who joins us on Fed Day, we've been so pleased to have him with us. He has a certain theoretical, almost mathematical monetary economics. Brainerd's is different, but nevertheless, when she speaks, it's the way people stop and listen is different, and that's what we're going to see today.
If anyone's interested in the time they will be speaking, scheduled to speak, this is the Vice Chair, Lael Brainerd, scheduled to speak at 1:15 Eastern Time, so a little bit later this afternoon. Mr. Williams of the New York Fed, scheduled to speak at an event here in New York at 6:35 Eastern Time. Of course, Tom, those things can change, but that's what's on the schedule right now for the Fed speakers.
Right now, a click, and we're going to do this in hydrocarbons, and I really want to give a major shout out to the London-based Bloomberg Green program. Everyone knows that Michael Bloomberg has done a massive philanthropy towards what are we going to do worldwide about coal. That is part of the discussion here on a new ESG and on a new oil forward, and even a discussion in Vienna for OPEC. Leading our coverage, Will Kennedy joins us here as well. Will, every time I look at Bloomberg Green, I get angry because the articles are long and they're so damn informative. I actually have to read them. And what I'm learning is there's a whole new lease on life for coal. Australian Newcastle coal, folks, this is north of Perth, and Australian Newcastle coal up 600% in the coal boom. How does your world, how does Javier Blas's world change with coal up 600% in price?
Well, I think that price tells you two things, Tom. One, it tells you that there's a broader global energy crunch, which we've been talking about over the last year, and that's impacted gas, and it's also impacted coal hugely. But it also tells you something about ESG. One of the reasons that coal price has gone so fast is because people aren't building new coal mines. We are relying on the coal mines that existed already. Right. And there is demand for energy, but there's no growth in supply of coal. So you get those two things together and you get prices like this. So there is, and on the surface, it looks like a world which is still relying on the coal, but it is being driven by how ESG is changing the world.
Well, Kennedy, when you take your hydrocarbons team and Akshath Rathi's green team at Bloomberg and you bring them together, there has to be a theme about, okay, China's going to reopen. My amateur take is China uses coal. What does that do to oil, and what does that do to ESG?
Well, we might expect Chinese energy demand to raise across the board, and my slightly cheap and easy line about Chinese energy is that they need all types of energy. They need old energy and they need new energy, and they're going to be drivers demand for both. The point that John Kerry made at the top of the segment there is very well made, however. If we think about solar, China installed a record amount of solar last year. It's expected to beat that record this year. And one staggering fact I was discussing with the team yesterday, China may well install more solar than the rest of the world put together in 2023. About half, maybe slightly more than half. That really tells you, as Kerry says, how much the energy transition is being driven in China. Now, the problem is its demand for energy is such, and that demand will be driven presumably by the reopening that we're discussing all the time at the moment. It's also driving up demand for coal. And they're using more coal. They're not attracted to gas because it's so expensive right now. So both of those things, huge investment in renewables, slowly creeping up coal demand, exist side by side.
Coal supply. Can we talk about that, Will, just briefly, and sit on Europe for a moment? There is this story going around, and we've been talking about it, that Europe got lucky, that Europe just experienced mild weather, and that's how they've gotten away with this, and it could have been much worse. Well, can you tell me how important it has been to actually reopen some of these coal plants?
Look, clearly there were times, especially in December when it was very cold across Europe, where Germany was using coal more intensively than India and China. So there's no doubt that Germany got through this winter, and as Javier said in his column yesterday, we can now say, I think, that Europe has got through this winter. But there's no doubt that only happened partly because it was warm, but also because Germany was able to put coal to work. But that coal intensity number over this winter was really striking, and in a country that purports to be a leader of the green transition, it's less than ideal, shall we say. Now, of course, there are extenuating circumstances to do with Ukraine, but it's quite a striking fact that they were using coal more intensively than China.
And folks, that's why Bloomberg Surveillance is committed to this. Is we got a guy like Will Kennedy that can inform me that Germany's a worse offender than what we see in the Delhi smog or what we see in 18 Shades of China. Frankly, I was in a hotel room somewhere deep into China, Will, and there were actually serious gas masks in the hotel room. The smog was so bad. Is Germany, is Eastern Europe, is the industrial France, are they going to have gas masks in the hotel room?
I don't think so. I mean, for all that I'm saying that number existed, it existed for a couple of weeks while they were experiencing very cold weather with no wind. It's
TV. Will, we got to make a show out of this. Give me more than a couple of weeks.
What I was going to say, I think there are definitely places in Poland, Poland, a country that uses more coal than any other in Europe, and where people were extremely short of fuel this winter, where they were burning all sorts of things, where the air quality was disastrous. And it certainly hasn't done anything for Europe's air quality across the board.
Well, diplomatic as ever and on point. Will Kennedy there out of London.
I learned a lot there.
Look, it's super important. It's not talked about enough. It's not just been the mild weather. It's been about these coal-fired plants, Tom. And I think we should go one step further. In Davos, Switzerland right now, there is a warm, fuzzy conversation about ESG, as there always has been over the last 10 years.
You're not warm and fuzzy.
No,
I'm not warm and fuzzy.
But that conversation we should highlight is laced with contradictions.
Yeah.
And has been particularly over the last 12 months even more so.
What did we learn there? What we learned is there's microeconomics going here with the success of a lot of people. We've gotten rid of the coal. John, you can see the San Gabriel Mountains in Los Angeles. That's one of the great triumphs of my life. I'm sure there's British examples. Think of Dickens' London. You could slice a knife through the smog. Things have changed. I get it. But what's now the next what? Given this war and given the build-out in coal we've seen, witnessed by Australian mining. Newcastle, John, is north of Perth.
Oh, thanks for that.
Thank you.
Thanks.
It's in my agreement, I have to say that.
My Australia geography. Why do you pronounce Perth that way?
That's because that's the way if you read Neville Shute and On the Beach in a town like Alice, we read, it was like Ian Fleming, James Bond, you read all of Neville Shute. And you learn in Neville Shute that you say Perth, not Perth.
Okay. For a moment, I thought we were going to have a serious conversation.
We are. It's Neville Shute. Neville Shute is serious. Everybody should read it.
Let's talk about those serious contradictions.
Yeah.
Another big lesson, I think, of the last 12 months, Tom, is that we've been told for decades by academics that trade and open trade between countries can help prevent conflict. And that just has not happened between the Europeans and what's taken place with Russia. That's a real reality check on several fronts.
Oh, massive. And this goes to Henry Kissinger and realpolitik. And there's been some really good essays on this. I would mention Robert Gates and Condoleezza Rice, who said, look, there were certitudes that have collapsed. For Gates and Rice, it was 2008 Belgrade. That was the moment where NATO overreached in terms of an opinion of a lot of people. And that's where the globalization failure came from in the continent.
It's a difficult moment, and the war continues. Equity futures right now on the S&P, if you're just tuning in, negative 0.7% on the S&P. In just a moment, we'll catch up with Sam Stovall, the Chief Investment Strategist at CFRA. Looking forward to that conversation. Tom, after a big start to the year, right? Big rally, and then the last couple of days.
It's entertaining,
last couple of
at the least.
All of a sudden, reality check, and I think a lot of people following all of this feel like the mood just follows the price action.
In 90 minutes, I believe it is, we're going to see some economic data as well. An email in. This is from Qantas from Perth, and he says also Melbourne. I say Melbourne, and that's like totally wrong.
Melbourne.
I don't know what you say, but
Melbourne, Australia.
I don't know. I say Melbourne, and I'm wrong. Thank you, Qantas, for that. Really appreciate it.
Can you say Melbourne? Go on, you've got this.
Melbourne.
Melbourne. Like Fulham.
Melbourne.
Have you got Fulham, or is it still Fulham?
No, it's Fulham.
There still are concerns about COVID. There still are concerns about geopolitics, and there still are concerns about whether the long-term growth prospects remain.
We're still optimistic that the disinflation story takes hold and goods prices don't have to rebound sharply.
The US consumer has begun quite a considerable divestment phase.
The impact of a year of very aggressive central bank tightening and quantitative tightening are starting to bite the economy, and they're biting hard.
We just expect that the Fed's hiking for longer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Man City Spurs later. Does anything else matter, TK?
The surveillance nap beforehand matters, but you know, we're not going to do football chat here, but it's really fluid now, and it's about global capital flows taking over English football.
I agree.
Including at Davos. If you and I were in Davos, we'd be out front, coming home from the piano bar.
Man United
we'd
store.
be out front the Man United store, which is across from the YouTube kiosk as well, and the Netflix store. We'll talk about Netflix here in a minute, but I'm sorry, it has to do with the internationalization of capital.
Well, to your point, we'd be 5 drinks deep outside the Man United store at midnight.
Who
And that's
isn't?
maybe why we're not there and Lisa is. And we'll catch up with Lisa a little bit later with James Gorman of Morgan Stanley. Looking forward to that. From New York City this morning, good morning for our audience worldwide. Equity futures, negative, 0.75%. This is Bloomberg Surveillance after a big day of losses yesterday, Tom, on the S&P, off the back of weak economic data. Retail sales, industrial production.
There's a shift. We've had an exciting moment here, and as we talked about in the last hour, we've had a shift back, and we see it. And John, my major message this morning, folks, is this is evenly distributed across equities, bonds, currencies, commodities. This is not idiosyncratic. It's not a story. It's a Seattle slew of economic data that was weak.
It's the story people have been waiting for, though. How the bond market responds to that.
The gloom crew has been waiting
Treasuries
for this.
up, yields lower, aggressively so.
Well, we're
right
back
the way
to
through
that
the curve
correlation.
yesterday.
We're back to that correlation.
Does it stick?
That's the big thing, and maybe it's about earnings season, and with Sam Stovall coming up, that's a good and beautiful thing.
And Netflix coming up as well.
This is important, and folks, I want to really make a program note of this. No one has been out front on this like Craig Moffett and Michael Nathanson. Jonathan Ferro, in the 9 o'clock hour, we'll have one M. Nathanson on him. John, that could be a 1-hour conversation. Push everyone aside.
Well, let's go back to sport. How frustrated are you right now with all these different streaming services? I line them up any given weekend. I've got Italian football on Paramount. You need that subscription. The Premier League football's scattered. You can see it on Peacock, or maybe you can see it on other networks as well with NBC. And then, Tom, I've got to go from Hulu to Paramount to Peacock and work out where on earth all this stuff is.
There's got to be a consolidation. That's the only solution.
That's
and the
basically what Michael Nathanson is saying.
Will not come from the bankers. It'll come from the public, and they're going to look at the gradients of to be posh and British this morning. The gradients. They're going to look at the gradients at cable. You're laughing at me.
Sure.
Bramo wouldn't laugh. You laugh. The cable gradients are there, and that's what's going to change the dialogue towards consolidation.
Cutting the cord in the United States, is that big theme over? Have we got the mass penetration we were waiting for? Feels like, Tom, can I use the word crappy? I just used it. Feels like it's turned into the crappy cable business that this wasn't meant to be. Wouldn't you agree? They were spending all this money on content, had all this growth, and all of a sudden, bang, reality check. Can't spend all this money on content, don't have all this growth.
There's more money being spent on contact, but the gross, I'd love to talk to Michael about this, but you have him, I don't. And the bottom line is the gross Hollywood P&L is one big loss. I mean, that, and whether it's movies or whatever. And, we'll talk about this through the day to the interest of Netflix this afternoon.
I watched Avatar for you over the weekend.
I'm glad you did tonight.
I took that one.
Surveillance movie report?
And nothing happened for 2 hours, and then the last hour was pretty good. I mean, if you like the graphics, then it's a nice experience for 3 hours, and maybe that's a nice way to relax. But I don't get it. I know people are obsessed with that movie, the first one from a decade ago. We're going to get the sequel after this one and maybe another one as well.
There was one magic night. This is at the piano bar years ago in the heart of Titanic, and there was James Cameron talking to us.
Right.
Me and Emily Hoskotzel, who invented all of this with us. And he was really down to earth, and he was riding high with Titanic. And imagine what he did. He went on and redid it again with Avatar. That's pretty cool.
Unbelievable success, and this movie's been a massive success as well.
This show is just cratered here.
Well, I just want hey, Tom, we're doing serious stories. Netflix.
No, it is.
Sport.
Frankly, we should weight it like we weight bankings. You and I are both guilty of that.
Sure.
We're very bank-centric.
Agree. Let's whip through the price action. Equities look like this on the S&P. We're down 0.8% on the S&P 500. Yields up after moving aggressively lower in yesterday's session. A bit of a bounce up 2 basis points on a 10-year. 338.78. ECB official after ECB official this week saying, guess what? More rate hikes to come. Euro dollar just a little bit stronger on the euro side of things. That currency pair positive, 0.25%. 108.22 on euro dollar. Joining us now is Sam Stovall, Chief Investment Strategist at CFRA. Sam Stovall, can you tell me, are we going to see a big rally that continues through this year off the back of this China reopening story, or are we starting to get a reality check about what's going to happen with the economic data right here in America?
Hey, Jonathan, good to talk to you. I think that China will be assisting economic and earnings growth as the year progresses, but I don't really think it's going to be a V-shaped pivot. Once they do open up, there are too many problems that investors have to overcome in the first half of this year here in the U.S. Questions being whether we do end up in a recession, how deep is it going to be, et cetera.
Sam, the arc of Robert Stovall to Sam Stovall is the arc of value lines sitting on the floor that you would trip over in the acclaimed star system of what you do at CFRA. And what's so important here, folks, is Stovall's not afraid to look at every sector where financial media is completely focused on tech and banking. It's a disease, you know it, Sam. Which sectors matter right now that nobody's talking about?
Well, what I find very interesting, Tom, is that we are seeing a rotation out of the defensive sectors, consumer staples, utilities, and into those groups that were beaten up back in 2022. I like to say that following a decline in any calendar year, the market has risen an average of 14% in the subsequent year, and we tend to rotate from first to worst, meaning that we tend to move out of those sectors that held up the best during the market decline and into those that were beaten up. So areas like consumer discretionary, communication services, real estate, et cetera.
Right. Sam, the 2-year yield it's a textbook chart, folks. It's screaming lower yields. Let's say, as a broad sense, Sam Stovall, you and I agree there's a disinflationary tendency. What does that do to your star system? What does that do at the top line revenue growth?
Well, I think when you have expectations for lower intermediate and longer term yields, the implication is that inflation is becoming less and less of a threat. The Fed probably won't need to be raising rates as much as they are telling us we need to worry about. We're thinking that they end up pausing after the rate hike on February 1st. And history tells us 9 months after the last rate hike, the Fed tends to cut interest rates. And so I would tend to say that we're likely to see an improvement in earnings expectations, an improvement in revenue growth prospects, and overall profit margins as well.
Can we talk about one industry, autos? Autos are at a really, really interesting point right now because we just had Tesla come out in the last week and deliver 20% price cuts in some places, including the United States and Europe, on some products. Sam, can you tell me how you think about how that might bleed through the rest of the industry?
Well, Tesla is so large on a market cap basis as compared with the other sectors within or the companies within the consumer discretionary sector, auto industry, et cetera. Discretionary is one of those areas that has been improving recently, and we're expecting to see earnings growth of about 10% in this quarter as compared with a 3% decline that we're looking for. Also, I think that the real question is if we can get Tesla to turn around. Our analysts are still optimistic on Tesla shares a year from here. But I think, once we get that kind of a rotation, then I think we could end up seeing an improvement in the sector, in the industry, and it's not just going to be Ford that's going to drive the way.
Well, can we just pick up on that? Because I think this is really important. Initially, when we saw those cuts, a lot of people saw a problem with Tesla. I just wonder, Sam, whether that's a problem for everybody else as they start to really invest significant amounts of money in their EV products.
Well, I think that the EV is certainly the way of the future, but a lot of stumbling is going to be occurring along the way in terms of the cost, in terms of the distance that these cars can traverse, et cetera. But I certainly believe that as time progresses, we go from the gas to the hybrid to the EV. I don't think it's going to be just a single jump. I think that hybrid will be around for quite some time.
Hey, Sam, good to hear from you. As always, Sam Stovall there of CFRA. Fascinating this moment, Tom, that we're having this conversation about the potential for an economic downturn, a rise in unemployment, and Sam is liking what he sees in consumer discretionary, at least in some parts of it.
You know, for those younger, this is the heritage and history of old-time financial media, where Sam Stovall's father truly owned the high ground. Robert Stovall was more than competent, particularly in times of crisis. And the measured view from Sam, which leads to that optimism, John, is about doing the hard work sector to sector to sector. And the modern disease is, what's Apple doing? What's Netflix doing? Wait, JP Morgan, that's all that matters.
Tom, you know that's not going to change because some of those stocks that you named, including Apple, have such massive weightings on the index that for a lot of people, they reduce what they looked at to just 4 or 5 names.
Energy a few years ago was the same massive weighting, and in 10 and 20 years, there'll be another. I just had a scary thought that Sam has kid that's going to come on air and continue the Stovall tradition. And I'll be there with my walker. I don't know, what do you think?
I'll be retired and you'll still be going.
Well,
that's what we'll be at.
I don't have a choice, young man.
I'm looking at one thing, Tom, and it's high yield. Until this week, high yield spreads have tightened every single trading day of the year, even with the survey data indicating things were not looking good. How that spread between the survey data and what's happening with high yield spreads reconciles in the next few months, I think that's the one to watch.
Where'd you get your first international anecdote where you had that moment? Folks, we're so privileged to do this, where, John, you were sitting there in London or here, and somebody emailed you from wherever. And you were like, oh my God, they're watching or listening. And when was the first one?
I guess Australia.
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 They're at night.
That people were listening
watching
in Australia in the evening.
Yeah.
To this show. I always thought that was pretty cool.
My first one was in Vietnam, a 15-year-old kid in Vietnam. My next one was in Perth because we did cricket. And I
think that was you and I together.
I'm as dumb as wood on this. I need to say good evening to Melbourne. And I was lectured from Melbourne.
What we're going to do.
It is Melbourne.
It's Melbourne.
Yeah, whatever. Melbourne. Good evening from Melbourne.
What we should do when we open this show is we should have different recordings for different places. So you get a good morning, a good afternoon, and a good evening, good evening.
Oh, that's brilliant.
We should just record a different opening
That's
for
a
different
value
places.
add.
Management will love that, and the amount of work that goes into it.
It's good.
It's a great suggestion.
Plus, it would take 5 takes for me to do it.
Equity futures right now on the S&P, negative 0.75% of 1%.
Sydney
is Sydney.
Sydney. Okay, good.
Have you got Brisbane?
Yeah, well, I mean, that's where I
Brisbane.
want to go. I just want to go see the Veronicas play in some club there. That's
Alicia
really
Levine of BNY Mellon coming up in the next hour.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A surprise announcement in New Zealand. Prime Minister Jacinda Ardern is stepping down before a general election later this year. She says she doesn't have the energy or inspiration to seek re-election in October. Ardern is 42. She became the world's youngest female leader when she led the Labour Party to power in 2017. European Central Bank President Christine Lagarde says inflation is still too high, and she vowed that the ECB won't let up their attempts to return it to their 2% target. Lagarde spoke at the World Economic Forum in Davos. She said a small contraction in the economy is now more likelier than a recession. Strikes coordinated by French unions look to bring much of the country to a standstill today. It's a protest against government plans to revamp the pension system and a test of President Emmanuel Macron's ability to resist street pressure. Workers in railways, schools, hospitals, and air traffic control are among those taking part. Ukraine's President Volodymyr Zelensky is once again calling on allies like the U.S. and Germany for tanks, artillery, and longer-range missiles. Zelensky spoke on a video link to the World Economic Forum in Davos. He said the additional weapons will be used to target Russian forces occupying parts of Ukraine and not inside Russia itself. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Similarly, the debt limit. I've been through a lot of these. I think at the end of the day, we will meet our obligations and not cause substantial disruption. but God, I wish we could move past this. It would be catastrophic for the United States and for our sense as a serious country if we were to actually default.
That was Larry Summers, the former Treasury Secretary, catching up with Bloomberg's David Weston over in Davos, Switzerland. From New York this morning, good morning. Looking forward to that conversation with Mike McKee, with Esther George, the outgoing Kansas City Fed President, Tom. A little bit later this week. That'll happen tomorrow. What time is that, Mike McKee? 10 a.m. Eastern time?
10 a.m. Eastern.
Very cool. Yes. You're going to the west of the country? You're going to Kansas?
Yeah, going to Kansas City.
Very cool.
Everything's up to date there.
Everything up to date on what front?
He has no clue what you're talking about.
He's not old enough. Old Broadway show.
What are we talking about?
It's
what are we?
From the Broadway show, Oklahoma.
Oh yeah, I did Oklahoma. I did Oklahoma at school. Yeah, I was in Oklahoma.
Really?
Acted in Oklahoma. Yeah.
You were in Oklahoma.
Yeah. I think I was the guy called, what was his name? Ali Hakim, who went around selling stuff. It was the salesman.
Oh, for a video.
That came through the town. I'm not sure we've got that on video. I'm not sure we have. I hope we haven't. That's for sure.
Here's what we're going to do. We're going to do a task force, a roundtable here on the silliness of the debt ceiling, the debt limit. I'm going to do a bit of history. Mike McKee joins us now, truly with the knowledge of the mechanisms involved and the damage that Professor Summers and, most importantly, the president of the New York Fed, former president of the New York Fed, Bill Dudley, talks about as well. And Anne-Marie Horton joins us in Washington with the political realities of the moment. Michael McKee, my mother sold war bonds, not World War I, I'm not that old, but she sold war bonds in World War II, and this was getting from Congress running things in 1917 out to 39 and 41, where they lost control of the debt process, and we began the silliness of the debt ceiling. Is this debate now like the 47 other debates that we've had over the years from 41?
It's the same in the sense that we have to raise the debt limit, which was originally designed to make it easier, because Congress used to have to approve every bond sale in a separate vote. It was designed to make it easier for Treasury to sell debt as we went into World War I. But now it's become a political football. And if the closed captioning on the TV is going to show what I say, just put sigh in there, because this is one of the more ridiculous things. Larry Summers said he'd been through many of these. I've been with him. 1995 was the first one of these I saw. And I remember that the Treasury Secretary at the time, Bob Rubin, came up with the extraordinary measures that they are now using, going into effect today. Janet Yellen announced it because you can see we hit the debt ceiling today. They basically are kind of accounting, bookkeeping things. They suspend investment in several retirement funds for civil servants, and then once this is all settled, they make them whole. Although once in the past, they lost about $1 billion because they didn't get made whole. The issuance of state and local government securities, which is very wonky, hasn't been done yet, but that may be coming very, very soon. We go back to 2011. That's the one that really got everybody's attention, because that's the one where S&P downgraded the U.S. and we almost had a major problem. This is the stock market and also credit card rates at that time. And you can see S&P just plunged when we got to the debt limit cliff and almost went over. And it sent rates for borrowing up significantly, and it was a major problem for the U.S. economy, and people tend to forget that. And this is when we did not default. If you look at what could happen, this is what Moody's guesstimates could happen if we hit a default.
Come on.
GDP falls by 4%, you get 9% unemployment, and we destroy $15 trillion in wealth. Now, this doesn't even address the fact that for years thereafter, our interest rates would be higher.
Let's bring in Anne-Marie Horton here now. And Anne-Marie, I'm going to suggest that the debt limit debate has a moral or almost religious tinge, a Calvinist tinge of debt is bad and morally, the whole thing. How much of the Washington Ballet is about the moral debate of this debt ceiling?
Well, this is really, it's political grandstanding, right? And this is an easy way for both sides to throw punches at each other. What we heard yesterday, and we talked about the last hour from Senator Manchin, is this idea of actually looking at it maybe in the way we did in 2010, which was this council that was basically called the Simpson-Bowles Council of 2010. But the issue is the right doesn't want anything when it comes to including tax hikes, but the left doesn't want to cut down on spending programs. So then you're left with basically this panel and their recommendations evaporating. So he was trying to incite that kind of mode of bipartisanship to look at issues on all fronts. But the issue is, Tom, both sides have drawn their battle lines. The Republicans are saying they will not raise the debt ceiling, which, by the way, is fake in the sense that Congress has imposed the debt ceiling, right? They say they will not raise it unless there are spending cuts. And the White House and Democrats, on the most part, are saying these are two separate issues, and we are not going to be taken hostage by the debt limit. So the battle lines are drawn. Whether or not they come and have a discussion, we have to wait and see. It's just too early.
You know how people on Wall Street view all of this? Just instantly on a Bloomberg, one message from a terminal subscriber, and Treasury yields rally on a flight to safety from default. There is this attitude on Wall Street that, Mike, this kind of stuff just doesn't matter. We get there. It's important, but ultimately it's avoidable. And the true test of how people feel about treasuries is that when we get close to this, they buy them. Is there any reason to believe it's different this time?
Yes, and that's the problem. I mean, we've gone through this many times. It's Republicans who usually bring this up. Debt ceiling was raised 4 times without any problem during the Trump administration. But it has nothing to do with what the government spends. So it's only a club to try to get the other party to do what you want. And so the odds that we actually default have always been pretty low because, we know this is a terrible thing. Except this time, analysts are saying, Chris Kruger from Cowen saying this could be a Thelma and Louise moment where we go over the cliff because the fat tails are there. This is a Congress with some real right-wing hardliners who have basically taken the attitude of let's see what happens. Representative Andy Biggs of Kentucky yesterday tweeting out, we should default.
I mean, that's stunning. I think that moment of silence is important. Mike, that's stunning.
Anne-Marie, well, I would go to Anne-Marie on this. I think it's important here. The new right, what's their power here to take a moral stance on the debt ceiling different from the ones Mike McKee's experienced?
Well, and to Mike's point with Representative Andy Biggs' tweet, the White House is just using that as fodder to say, look, these Republicans are not serious about the health of the U.S. economy. This is different, as Mike says, because of these groups of hard right-liners. And their power was on full display at the start of the 118th Congress. It took more than a dozen votes to elect a speaker. Again, this is the plumbing of Congress, the plumbing of democracy. This should not have been a spectacle in the way it was, and in terms of how we've seen it in the past, right? You come, there's a plan, you have the power, but they used it for mass concessions. Some of those concessions, by the way, are about this issue, the debt ceiling. And the power they have is this one motion, right, one individual to vacate, meaning one person can call for the ousting of McCarthy if they don't like how he's handling a situation. The debt ceiling is the situation that is going to be front and center for the next 6 months.
We're going to talk about this at length, but Robert Skidelsky, the giant from the University of Warwick, he makes clear looking
Warwick.
Oh, excuse me. I thought it was Warwick.
It used to be, I mean, it's my former school. So,
Oh, it is. I didn't know that.
Tom speaks English, but not British.
But David Graeber has a definitive debt, the 5,000-year history, and as Skidelsky of Warwick states, this is about a moral consequences. This goes back to Ben Friedman at Harvard.
Yeah, except that the debt ceiling is not moral. I mean, you can argue about the debt.
Tell that to Henry.
But all the Republicans and Democrats have to do is sit down and negotiate, and it has nothing to do with the debt ceiling. Pass the debt ceiling, but just spend less if you don't want to spend it.
Roadshow, Warwick, it'll work.
I would say relax. We've got another 6 months of this. Maybe longer.
It may take a disaster to get this done.
We've seen this movie before. Will it end any differently? Love the Thelma and Louise reference there, Mike.
Who are they? Economists?
I knew you hadn't watched that movie.
No.
Economists, yes.
No, they're economists?
Susan Sarandon would love that.
Okay,
yeah, Brad Pitt appearance too.
Really?
Only you would think Thelma and Louise were economists. Only you would come up with that.
I'm sorry. I've had a sheltered life.
I can tell. From New York City, let's get some price action for you on the S&P. Got a message a little bit earlier this morning. Tom, good night from Sydney. So there you go.
There you go.
There you
it's
go.
Sydney. Okay, thank you. I like that.
There's another one in Australia tuning out. Equity futures negative 0.75% on the S&P. On the Nasdaq, we're down 0.8%. The loss yesterday on the S&P, the biggest one-day drop on the S&P 500 since the middle of December. It had been a pretty decent start to the year for equities worldwide. And just the last 24 hours, we pulled back, particularly in the United States, off the back of weak economic data, both retail sales and industrial production. That weighed on the yield curve, that's for sure. Let's get to the bond market. 2-year, 10-year, 30-year, aggressively lower in yesterday's session. So we're just north of 4% now on a 2-year at 4.08% after looking at 4.80 at one point, getting very close to that level intraday at one point in the last 12 months. In October, keep going back to this, in October 4.33, 4.34 intraday on a 10-year. Right now 3.38.42, Tom. Yields aggressively lower yesterday. Today up about a basis point.
I'm going to use the phrase wait to the tape. I mean, there is follow-on from yesterday's equity weakness.
Off the back of the economic data. Let's see what the data looks like this morning. 8:30 Eastern time, we get jobless claims about 60 minutes from now. Let's finish on foreign exchange. Euro-dollar looks a little something like this. The euro against the US dollar, 108.19, 108.20, positive 0.25%. I've got to say the hawkish ECB speak continues. It was the French central bank governor in Davos, Switzerland, speaking to Francine yesterday. Today it was ECB President Christine Lagarde. And not only her, but also the Dutch central banker Klaas Knot from the Netherlands, saying we are focused and only focused on the risk of doing too little right now. The ECB right now sounds like the Federal Reserve maybe in late summertime.
Yeah, I like that idea that they're 6 months behind, maybe 3-4 months behind, but I don't know what they're behind into because they have a war, we don't. And I just think it's not that Madame Lagarde could be overcome by events, but I just think it's way more fluid over
there. Good news. Let's frame what good news actually is in Europe. Good news is avoiding recession. They're still looking at something like 0% GDP growth through this year, Tom. Are we going to get some good news later this summer? The debt ceiling standoff looms in Washington. Bloomberg Opinion's Bill Dudley wrote the following. The debt limit doesn't contribute meaningfully to fiscal discipline. It encourages political grandstanding. It risks the default of the world's wealthiest and most powerful nation. Tom, it should be abolished. The words of Bill Dudley on Bloomberg Opinion.
Strong language. William Dudley is an important economist. Yes, the former president of the New York Fed, but someone more than any at the Fed steeled in the grind of market economics and actually working day to day through policy realities. Bill Dudley joins us this morning, writing for Bloomberg Opinion, a huge contributor. Bill, I was talking with our Michael McKee, and this goes back to McKelvey and you on the fiscal state of the nation at Goldman Sachs. In 2011, and even more recently in 2015, the Fed was proactive in modeling out debt ceiling outcomes. Do you just presume they will do that this time? And how will Jerome Powell and company assist Congress in measuring those tail risks?
Well, there'll definitely be contingency planning. What do you do if there was a default on the debt? What do you do if there's not a default but prioritization of payments? The way it works is if you actually run out of money, the Treasury will decide what payments to present to the Fed. Presumably, the Treasury will decide to prioritize debt repayment and interest payments so there isn't a technical default. And then the Fed will basically honor the payments that the Treasury presents. But what the Fed can do also is actually shore up market functioning in the Treasury market. What we saw in 2011 is the Treasury market got very unsettled as we got close to the deadline. People don't want to buy Treasury bills that are maturing right around the time when the debt limit could be binding. Money market funds, there were outflows from Treasury money market funds into commercial banks. And so the Fed does have a responsibility here to try to preserve market functioning. And there's also the question, of course, of the debt auctions themselves. The Treasury auctions the debt, but the Fed actually runs the auction process. And it's really important when we have those auctions that there are more bids than what's on offer. If there were not enough bids, an auction would fail, and that would be a terrible blow to the financial markets.
You know, I look at this, Bill, and I'm going to go to your Berkeley economics and the great Barry Eichengreen and what he said about gold and the emotion of gold. How do you respond to the moral consequences of our debt, the emotion of the right, and they had a huge response to your Bloomberg essay, the moral consequences of this debt? How do you respond to that like Eichengreen would respond to gold?
Well, a very simple point is that look what's happened to indebtedness over the last 20, 30 years. It's soared, even though we've had this debt limit ceiling in place all during that time. So the debt limit clearly doesn't restrain spending. We've tripled the amount of government debt relative to the economy over the last 30, 40 years. And, so the debt limit's not really doing much to actually constrain things. I also think you don't really want to mess around with the creditworthiness of the United States, because if you do mess around with it, even if you avert to a disaster in the end, it can have consequences. In 2011, the debt limit was raised at the end of the day barely in a timely way. And yet the S&P downgraded the credit rating of the United States from AAA to AA+. So there was a consequence, even when there wasn't a technical default on the debt.
Bill, you experienced this when you were at the Fed. Mike McKee was talking to us earlier. He just messaged me. He said the FOMC in 2011 and 2015 gamed out possible Fed responses to a default. What did you think you could do back then?
Well, I think there's a couple of things the Fed can do. The Fed can basically tell market participants that we're going to continue to engage in the Treasury market. We'll take defaulted securities as collateral, just as well as the securities that haven't defaulted. You don't want the market to start to really lock up because people can't raise money against Treasury collateral because they're worried that collateral could be in default. So the Fed has basically said we're going to take defaulted Treasury securities in all our operations. The only difference between defaulted securities and non-defaulted securities would be we value defaulted securities at market prices. So the Fed's basically saying we're going to keep the repo market functioning. We're going to keep the Treasury bill market functioning. Now, if things got bad enough, the Federal Reserve could also engage in interventions in the secondary Treasury market. They could actually come in and buy, like we saw during the early stages of the COVID pandemic. Fed would not want to do that because they don't want to get involved in the middle of a political controversy. But if the Treasury market really started to melt down, the Fed would probably come in and participate in the secondary market. The Fed can't do anything about the auctions themselves because the Fed is precluded from buying directly from the U.S. Treasury.
So, Bill, let's just build on this. The attitude of people on Wall Street, as you know, and we're all familiar with, is that this happens, we get through it, and if it gets dicey, guess what we do? We buy treasuries. Now, Bill, you get all those kinks at various tenors at the very front end of the curve on T-bills, but, Bill, ultimately, people still buy treasuries. Do you see that changing whatsoever?
I think that that's what generally happens, and I think that's mostly right. I mean, basically what people assume is that there's going to be a lot of drama, but in the end, the debt limit will be raised in time. Now, so what that means is if we mess up even just one time and don't raise the debt limit in a timely way, it's going to be a huge market surprise. So you go from thinking that the probability of default is 0.01% to all of a sudden there is a technical default. It'd be a huge blow to financial markets.
Bill, tell me about our ratios as compared to the maximum doom and gloom of Japanese ratios. To our listeners and viewers, in a debt ceiling debate, the 3 or the 4 or the 5 ratios that matter, are we fiscally constrained or are we doing okay?
Well, I think the big difference between us and Japan is we very much depend on the kindness of strangers to hold our government debt. The U.S. has run, as you know, current account deficits for decades. And so a lot of the U.S. assets are held by foreigners. Foreigners don't have to hold U.S. debt, obviously. And so there is a risk that they could decide that maybe the U.S. isn't so creditworthy.
Well, they're creditworthy. And I guess we're going to, as John mentions, Wall Street says, OK, let's get through this in the autumn and move on. And you suggest there could be a singular damage given one screw up. What is the proactive process of Secretary Yellen? Not to get a bipartisan support, that's impossible, but what is a proactive process of Secretary Yellen to solve this before the autumn angst?
Well, I guess what you have to do is convince a number of Republicans, more moderate Republicans, to come over the fence and join Democrats in raising the debt limit in a timely way.
Bill, I just want to wrap things up with the recent economic data if we can, because we have about 60 seconds left with you. The recent survey data, Bill, how much weight would you put on it? What we're seeing in the ISM, what we saw in Empire Manufacturing earlier this week?
Yeah, things are definitely weaker, although I think part of this is just the rotation away from goods back to services. And I think we really need to see the January data because we don't know how much Christmas sales were distorted by the fact that people bought a lot of stuff in prior years during the pandemic. So I want to see what the January data looks like, and then I'll have a better sense of whether this Christmas weakness is just a lull or whether it's something more serious.
How would you change your thoughts going into the next FOMC meeting if you were still there? Does this do anything to change your thoughts about the pace, the ultimate destination?
They've made it very clear that it's going to be 25 basis points at the next meeting, and the weaker inflation data and weaker activity data confirms that. I think it's almost certain that they're going to do another 25 basis points move in March, And then maybe the May meeting's up for grabs, but I think it's going to be hard for them to stop, because if they stop, financial conditions are going to ease and the amount of Fed rate is going to lessen.
Bill, this was great, as always. Thanks for squeezing that in at the end. We appreciate it. Bill Dudley there, the former New York Fed president, on policy, and not just on Fed policy, Tom, on this debt limit debate that we're going to have later this summer. The ex-date, I'm told, is either as early as July or maybe as late as perhaps October, Tom. So that's a big window.
What's so odd about this, and this is, of course, reading Goldman Sachs' Dudley McKelvey cover to cover a million years ago, is John, it used to be partitioned. The Fed never talked about the dollar. The Fed at angst talked about fiscal policy. There was no modern monetary theory conflating this where Congress helps a solution of monetary troubles, etc. And now it's all in a jumble together. And for our listeners and viewers, I don't even know how to advise them who to listen to. I'm not even sure where you go within this debate.
I think Bill nailed it. No one expects this to be a problem. So if it is one, it could be absolutely massive.
Yes,
that's the issue.
100%
You'll hear it again and again and again, and I hear you at home. I know what you're saying. They're going to buy treasuries when things get dicey. That's what always happens. Does that change this time around?
Well, that's the question.
That is the question. There is no other one.
Look at. To me, I was going back and forth with Anne-Marie on this. I want to make clear the political grandstanding phrase that Dr. Dudley used in his important essay is there. Why is there political grandstanding? Because there's a huge body of Americans who feel debt is a moral evil. It is evil that the U.S. is in debt. And at the same time, they're getting massive transfer payments from the United States of America. They're cashing the check, even as they morally hate the debt, which leads to the political grandstanding.
The latest piece from Bill Dudley on Bloomberg Opinion, do away with a debt ceiling that serves no purpose. I think you can probably
Do they have this conversation in England?
We don't. You can put that article on the shelf and maybe repurpose it in a couple of years again as well, Tom.
I don't think there should be a debt ceiling on the tots. I think they have to rebuild.
Oh, you think they should just spend?
That's bad.
I bet. No bias there, Tom.
No bias there.
Equity futures on the S&P down 0.8 of 1%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The world's first youngest female leader is stepping down. In a shocking move, New Zealand Prime Minister Jacinda Ardern says she will resign ahead of a general election in October. Ardern told reporters she doesn't have the energy needed for a third term in office. The Labour caucus will vote on a new leader January 22nd. The U.S. is adding another more powerful weapon system to a military aid package for Ukraine. Bloomberg's learned that about 100 Stryker armored vehicles will be included in a $2.5 billion package. It will be unveiled as part of a broader announcement by Western allies of new hardware for Ukraine. That's set for Friday. In Brazil, President Luiz Inácio Lula da Silva is downplaying the importance of an independent central bank. He told Globo TV it's silly to think that an independent central bank governor would do more than what he was appointed by the president. Now, Lula also vowed to see that those who rioted against him earlier this month are brought to justice. And Apple plans to take on Amazon and Google by expanding its smart home lineup. Now, there will be new displays and faster TV set-top boxes. And that comes after Apple relaunched its larger HomePod speaker. And the new product line will start with a tablet that can control things like thermostats and lights, show video, and handle FaceTime chats. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
What is different this time is everyone's on the lookout for a bubble. Is there complacency or not? We've all been expecting a recession. It hasn't come yet. There are a lot of reasons why it may be pushed off until the back half of this year or maybe into next year. And you do have new tools out there.
Bob Michael at JP Morgan Asset Management was absolutely brilliant yesterday on Bloomberg TV and Radio. Sat with us for almost a full hour. I pulled out a really important quote from him a little bit earlier this morning, Tom. He said this: the impact of a very aggressive central bank tightening, a year of it, plus QT, are starting to bite the economy. It's biting hard. Investors are making the decision, Tom. get into bonds. And what did we see yesterday? Investors piling into set treasuries, sovereign debt.
It was
yields.
a Bob Michael day, absolutely. And
Lower
this,
big time.
And this, again, is a disinflationary tendency in how you handle it. And you know, I leave it up. I think you're doing a better job than me on this. I would say the curve inversion's not the story. The real yield comes in a little bit, but it is about specific yields and specific
Just
spreads.
about how the whole curve, Tom, has just dropped. The inversion's still there, but ultimately the whole curve too is out to 30s. Yields aggressively lower. I can tell you your 10-year right now is about 3.39, just short of 3.40 on a 2-year, just north of 4%, 4.08%. Can also tell you that equity futures are just a little bit lower. In fact, near session lows, down about 0.8%. Tom called it down 0.9%. Your next stop, Netflix earnings after the bell.
It'll be interesting to see. Right now, and this is what we do at Bloomberg Surveillance, we want to bring you experience on the sell side, on people advising and doing securities research. She is a legend in the business. She is Jessica Reif-Ehrlich. She is media and entertainment analyst at Bank of America. And long ago and far away, she would put out a 10-page effort for OPCO, and we would all have to stop and read every word and every sensitivity analysis of her work. Now she has a new war. It's the streaming wars, and we're honored for Global Wall Street to take notes this morning. Jessica, thrilled to have you here and honored. How bad are the streaming wars?
Well, first of all, thank you for having me, and thank you for remembering Oppenheimer. That's a long time ago. You know, with the exception of Netflix, everybody is losing a lot of money. But it's critical that the traditional media companies make the transition. Linear pay TV universe is declining and declining quickly. And the viewers are going to streaming. They want to watch what they want, when they want. And so ratings are down dramatically, and the ad dollars will follow.
Jessica, I look at your optimism on streaming, and I'm going to go to the most troubled, let's call it David Zaslav's Warner Brothers Digital, WBD. You're at lunch with him at the Sunset Tower Hotel. What's your question to Zaslav, and frankly for the rest of the industry, about what's the rate of change here? What's the speed forward for the streaming wars?
Well, they're a little bit different. So that's an interesting company to pick up. WBD, Warner Brothers Discovery, will launch their combined service in Q2. And we don't know exactly what that will look like, how it will be priced. Do they keep Discovery Plus? Do they keep it a la carte, but also integrate it? Because there's a very loyal following. It's a cash cow. But remember, Warner Brothers Discovery has an enormous library. It's not just Warner Brothers TV and film, but they also have all the Turner library. So when they launch, our expectation is they'll have news, they'll have sports, they'll have entertainment, they'll have documentaries, they'll have nonfiction. So that's a little bit different. The ones who have launched already, like Paramount Plus or Peacock or Disney Plus, you can see their numbers. They're losing billions of dollars. And like again, just to go back to what their losses have peaked.
But Jessica, to your enthusiasm on Netflix and to get to this afternoon or Mandalorian coming out for Disney Plus to save the day, when do they get to profit? What is your x-axis at Bank of America when they finally turn profitable?
Well, in the case of Netflix, they are profitable. So they are at a completely different level than all of the other traditional media companies who've kind of joined the party later. There are massive losses. In the case of Warner Brothers Discovery, their losses have peaked in 22. In the case of their peak losses should be this year, Paramount Plus and others next year.
Right.
So there's kind of a long road to profitability. And the margins in the business, we'll see what they really are ultimately. Are they 20%? Can they climb, can they scale up beyond that? But it's clear that the economics will be far worse than the pay TV, the traditional pay TV bundle.
I got 8 ways to go here, Jessica. I mean, there's so much to talk about in the ferment of the losses being taken. I think I've got to go to the heritage that we see right now debated at Disney over Fox. Mr. Peltz is in there knocking around and others, and it's about a gentleman in his 90s, Rupert Murdoch. What is your outcome? I mean, if I was having coffee with you and Gordon Crawford, I'd say, what is the outcome for the Murdoch empire 5 years from now? How do you visualize that?
Well, I think Rupert Murdoch has proven to be the smartest person in Hollywood. He sold at the peak, and the assets that he kept are the live assets, so live news, live sports, and they're doing very, very well. Obviously, there are cyclical headwinds in advertising and secular pay TV, but they are not losing billions of dollars in streaming like others. So Fox is in a very different position because they're much smaller, they're bite-sized, they could be broken up, or they have a great balance sheet, they could buy something. So they're in a completely different position than the other companies that you mentioned, whether it's Disney or Paramount or, Comcast with NBCU.
This might sound like a rant, but perhaps because it is. Tom and I were both having this rant, Jessica, a little bit early this morning. This was meant to improve the user experience. It hasn't. It was meant to be cheaper. It isn't. Jessica, it's become increasingly expensive. We all look at what we pay now for these streaming gaps, and it adds up to way, way more than what we were paying for cable. How does all of that end, Jessica, do you think?
Obviously, consumers should have probably stayed with cable, but that's over. I mean, the trend line is there. We'll see where cable levels out, but you're 100% right. And that's why the biggest issue facing streaming is churn. And consumers, it's very easy to turn on and off these services. Unlike cable, where you had to wait for, a serviceman to come and disconnect, take your set-top box. It's just easy to go on and off. And so that's part of the issue with economics of streaming.
Jessica, you and I lived this. I remember Dennis Leibowitz at DLJ doing the same thing. It's one of the dumbest things I ever did, folks. Leibowitz told me that you're going to have to pay $50 a month for cable, and I told him he was nuts. And, of course, I was totally wrong. Let's take it back to the guy that invented this. This is Brian Roberts and the Roberts family at Comcast. What does traditional cable do to get back to the persistent cash flows that they enjoyed? To me, it's done.
Well, I 100% agree. Brian Roberts is one of the smartest people I know. And, they've done an amazing job. They're very astute when they do deals. They've seen around corners. Peacock actually launched, they were the first AVOD service. Their content, they haven't invested in content the way some of the others have, and they haven't had those losses either. But as far as, the video business, it's shrinking for them, but they've been very creative and strong in broadband. So their broadband business is it's much larger than video, and they've also been more aggressive in terms of trying to capture viewers and make it easier for them to watch all apps in one service. Right. I'm sorry, the Time Warner Cable was the government wouldn't allow them to do it. Having Comcast in New York would have been an amazing thing because they really make television or viewing very easy.
Jessica, John's got to say goodbye, but Jessica, to be honest, all we want to know is, do you have the power to get English football, Premier League football on one streaming service? Can you fix that for us?
I don't know about that, but I think, isn't a lot of it on Peacock?
It is a lot of it, but then you've got to guess, is it on Peacock? Can I find it on Hulu on live TV?
And NFL football was down this year because it was on Amazon, and old folks
drives me nuts.
Find Amazon.
Jessica, thank you. This was great. We've got to continue this conversation.
Yeah.
Jessica Reef-Ehrlich there of Bank of America Securities. Thank you very much. It drives me insane. It drives me absolutely insane. I've said this before. I cut the cord because I thought it looked better. I just didn't want the cables in the house anymore, Tom. I didn't want the cable box, and that worked out for a little bit. And now all I've got Hulu, Paramount, we've got Apple, Netflix. You get Prime with Prime, don't you? What else have we got at home?
I have way less
Have I
than
mentioned
that.
Peacock?
You know what I do?
On.
And this is what I do, folks. I've talked to Paul Sweeney about it, who, like Jessica Reeve, is expert on this, is I just won't do 5 or 6 or 7 services. The kids don't watch it.
But only want two things. Only want two things.
I know, but...
The sport and the news.
With kids, here's the reality. All they do is they're on TokTik. They don't care about
You're calling it Top Tick?
Yeah.
That's your new name for TikTok.
It's what it's called.
That should be its own device, Tom.
You enjoy?
Top
She's
tick.
great. She's like
we
legend.
can give out trade recommendations and just call it Top Tick.
Yeah, we should.
Like an inverse sort of research.
We could do a video stream on it.
Product. That'd be great, Tom.
Our core call is that we're rallying into recovery and that we're going to hit a soft landing.
It just seems very aspirational to me that it's all going to end in a soft landing. We'll reset and move on.
There is a delayed pass-through. Monetary policy has famously long and variable lags.
The market is misinterpreting, the Fed's commitment to getting rates above 5%.
Markets don't have to crash, don't have to surge.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz in Davos, Switzerland, and I'm Tom Keene. Thank you for joining us in New York on television, on radio. A most interesting day here, and what you know is the rally of 2023. It is over. John, what a day yesterday. Follow through today. Futures at negative 34.
We're down 8 or 9/10% on the S&P 500. Biggest one-day loss of the year so far, going back to December, actually, of last year on the S&P. Off the back of weak data. Bad news, bad news. Industrial production, retail sales, and bad news meant good news for anyone long treasuries. Yields aggressively lower. Tom, will jobless claims defy the gloom? A little bit later this morning. 8:30 Eastern Time. The number we're looking for is 214. 214 doesn't scream recession.
And to Mr. Harker, who talked, I believe, yesterday with Fed Speak today as well, I'm sorry, the Philadelphia Fed Business Outlook, a tertiary statistic, but after the Empire disaster of Buffalo, New York, I got to be looking at Mr. Harker's land to see what the spirit is.
They're in risk management mode. They're worried.
They're
worried.
well said.
And I think if you're in risk management mode, you go to 25 and you move away from 50, and that's quickly become the consensus. But ultimately, has the story changed? Has the destination changed for them? I hear 25. I also still hear 5. I still hear 5 on Fed funds, and ultimately the data will dictate whether they get there or not. But, Tom, I don't think they've thrown in the towel on that commitment just yet.
Citigroup was nuanced yesterday on how not to get to 25 and at 50 get it done. A la Bullard, let's go move quicker, and then stop has a merit to it.
We know why they keep talking about 5. Petrified of repeating the mistake of the 70s, Tom, and backing away too early. They're petrified of it.
Yes.
They are conditioned by history to keep on
this.
going. And that's what you hear from Bullard, it's what you hear from Mester, it's what you hear from others.
This is the asymmetric risks, and we haven't talked about Japan today. I don't think we need to do it now. It's some sort of a quiet day there. But this is the asymmetric thinking of Fed officials, central bank officials, and I'm going to say that comes over to the asymmetric mysteries for corporations like Netflix this afternoon.
And Netflix after the close, and big tech starts to report, Tom, and big tech has had a difficult time. Our next guest is going to talk about how big tech is not making a comeback anytime soon. That leadership story of the last decade.
She was invited to Davos. She had a negative tech view, and they said you can't.
We're not allowed to go either.
We're not, is pessimistic and all that. Let's do the data here, John. And I got to center in today on the 2-year yield, which I think, it's come back a little bit, but I'm sorry, a 3.99 2-year yield changes the dialogue.
Against the Fed, in the face of a Fed saying we're going to 5. And we just keep
we're not
moving
there
lower.
Yet.
I agree, we're not there yet. 4.1% on a 2-year, just short of that. On a 10-year, though, what a turnaround on a 10-year yield. Today, we've got a bounce up 4 basis points. That might change. 341, let's call it. But we've been trading in the 330s after trading in the 430s only back in October. That is a real correction.
And to the housing data to come out here at 8:30 is, excuse me, I knocked my microphone there.
That's okay. They're attached to each other. It's like us, Tom, in real life. It's just a beautiful partnership.
It's just beautiful. Housing starts, building permits, and the such. Yeah, mortgage rates have come in, but I really wonder what the trends are that we're seeing in real estate nationwide.
I'm told to look at cancellations. What's happening there? People that were looking to buy a home and are now cancelling that transaction.
Is this in the 60s and 70s where you're closer to the office, or you're thinking of something?
Are you talking about me purchasing? I'm not purchasing right now. I haven't seen the correction.
What's interesting?
I haven't seen the correction in New York real estate in the way that I thought.
Oh no, not at all.
It's just not.
Mayor Adams has talked about
I've seen rates
this.
go up, sure, but I haven't seen the prices come down enough.
We're going to get to our guests right now, but I want to make clear we don't think rationally about real estate because we live in this odd city. And again, we welcome you across the nation, and particularly in Melbourne today. Thank you for the emails from us. Did I do that okay?
Nice. And just for the record, I'm about to renegotiate my rent. So if the landlord's listening, it's a terrible market. It's absolutely terrible. It's abysmal. You don't want to do it. You just stick with it. Equity futures right now on the S&P 500. No bias here in the equity market. Look like this. We're down 0.9% on the S&P. We're down about 35 points on the S&P 500. Yields, Tom, on a 10-year, 341.
We go math on a Thursday here, 26 minutes before economic data. Alicia Levine holds high ground on mathematical acuity and looking at equity and capital markets with BNY Mellon today. I'm going to go mathy on you right now, and let's go Newtonian calculus, first and second derivative. What's the convexity out there that most has your attention? What's the accelerative force that scares you?
What scares me is really the pricing in of the soft landing that has happened since the beginning of the year, because as you know, it's not actually what happens in the data that moves markets. It's what's already priced in. So everyone was defensive by the end of the year. We flipped over, China reopening, the growth impulse, tech's going to make a resurgence, yields are going lower, great for stocks, great for multiples. The soft landing is out there, and it simply wasn't priced in at all. Then we moved towards that, and I think that's ultimately the risk. In the end, the peak Fed funds rate as priced by the market is about 50 basis points less than where we think we're going. That's the issue. It's not that the market is necessarily wrong. It's that if it is wrong, the reaction is not going to be a pleasant one in equities.
Nassim Taleb, with my phrase last year, the gravity's returned, the Sharpe ratio, risk-free rate, and all that. He's got a book, magisterial and misunderstood, called Anti-Fragile, which is the mathematics of what you don't see because you don't have skin in the game, which leads to the shadow banking debate. What's the mystery out there in the bet that's being made for 2023?
The bet that's being made is that the macro story from 2022 carries over to 23, meaning that if the second derivative on inflation is negative, that is lower growth rates or even deflation, that will rally the market. That is the problem, because the bond market has already priced in the recession, has already priced in lower inflation. And with that, if you're only looking at multiple expansion as a way to rally the market, when most market participants are assuming that earnings have to come in, that's the problem. The story this year is the earnings risk and the recession risk, not the inflation risk anymore. That second derivative is clear, has been clear for several months. It's being driven by a drop in commodity prices, a drop in the goods pricing. That's been clear, but you can only go so far on that. And that's the dance between lower yields, lower inflation prints. But ultimately, if you're getting to 2 or 3%, it's because you have a recession.
Where does that leave tech? How cyclically challenged are some of those names?
So there's, we've talked about this, for the last few months. The multiples there are still too high. In every cycle, there is that moment where leadership shifts. It typically is caused by a recession or some kind of an event. And you see it very clearly. What happened here was sort of that excitement of multiples and tech and, exponential growth. And then it started tipping over by the middle of 21, more towards the value, industrials, materials, commodities. So we think the next cycle, I'm not saying for the next year, but for the next cycle, the growth stocks simply will be more challenged because they were the leaders before. And if you go back 50, 60, 70 years, there are very clear cycles of outperformance, and the break tends to come around recessions or big events. And COVID was one of those events, and the slowdown is one of those events.
Regime change.
Regime change.
Your phrase. Yeah. I think Satya Nadella of Microsoft's been pretty clear about it. They're not hiding. The Microsoft CEO this week, Tom, in Davos, the following words, and I keep saying this, they are not hiding. They're telling you this loud and clear in their actions with job cuts, in their words. Here's the quote. During the pandemic, there was a rapid acceleration. I think we're going to go through a phase today where there is some amount of normalization in demand. Alicia, they're just telling us up front, aren't they?
That you don't fire people when you have growth ahead of you. You fire people when growth is slowing. And so the message we're getting from this particular sector is that growth is slowing. We've seen it in the stock prices. That's not all tech, but you still have stocks that are trading at 60 times forward earnings. Those have to come down. They tend to be concentrated at the top of the market, concentrated at the top of the index of the S&P. Okay. So ultimately, that's a tough place to be, relatively.
You're not all in cash. What do you own?
No, we are not in cash. We don't do that. But we don't. So we recently raised our exposure to fixed income. We did that at the end of last year. We're implementing it this year. We have tilted our equity exposure to be more value-oriented and to look at some of those names that are underneath the surface, not the top 10 names that everybody probably still has in their portfolios, hoping that they're going to outperform this year. So we're looking at more value. We're looking at growth at a reasonable price. Tech names that have earnings and dividends and cash flow, that's Great. That's what's going to work this year. It's simply the growth at any price won't work. And that story was last year, and that will continue in this cycle. If you remember after 2000, nobody wanted to own tech for about 7 years. Very hard. Tech rally.
Same thing here?
Not the same thing here, but the leadership will not be here, and the lesson will be hard learned.
That's going to compromise the index in a massive way, isn't it?
Massive. You can still make money in the different sectors. We like industrials, we like materials. We're still long energy because we think. By the way, let's talk about the fact that WTI quietly went from 70 to 80.
We've been talking about that. You haven't been watching, but we've been talking about that.
She listens and watches every day, Tom. What are you talking about?
I think what's
Alicia,
important
can I say
there
how
is
nice
the
it was to have
partition.
you in the studio? This is just awesome.
Yeah.
Thanks for making the effort. It makes a massive difference.
So great to be here with you
cut
guys.
me off there.
Well, that's because time's up, Tom. Just getting towards the end.
We-
Plus, you
oh, we
started to be
gotta-
rude as well.
Yeah,
It's my job to rein you in sometimes. Alicia, thank you. Alicia's been there. FB&Y Mellon, Wealth Advisory.
What she said about the partition between cash flow and others, that's where I am.
Regime shift. Take
Regime
leadership, not
shift.
return.
Free cash flow is gospel.
Do you want the latest from Citi?
Please.
They're going with 25. They've got their 50
big
club.
shift. That's important. Thank you.
Daily update from Andrew Hollenhorst to the team. We caught up with Veronica Clark. We tried to get this out of Veronica yesterday from Citi. I told you they've got to wait to publish.
You got to start asking more questions,
The
and maybe
headline.
we would have got it out.
Slow into 25. Is that a dig at me? Softer PPI. Core PCE inflation, likely 0.32% month-on-month core, following softer wages, are likely to convince Fed officials to slow the pace of rate hikes to 25 basis points at the next meeting. They're looking for 25 over at Citi and move away from 50. Are they still committed, though, to this idea we get to 5? That's a conversation we need to have. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A surprise announcement in New Zealand. Prime Minister Jacinda Ardern is stepping down before a general election later this year. She says she doesn't have enough energy or inspiration to seek re-election in October. Ardern is 42. She became the world's youngest female leader when she led the Labour Party to power in 2017. European Central Bank President Christine Lagarde says inflation is still too high, and she vowed that the ECB won't let up in their attempts to return it to their 2% target. Lagarde spoke at the World Economic Forum in Davos. She said a small contraction in the economy is now more likelier than a recession. Ukraine's President Volodymyr Zelensky is once again calling on allies like the U.S. and Germany for tanks, artillery, and longer-range missiles. Zelensky spoke on a video link to the World Economic Forum in Davos, and he said the additional weapons will be used to target Russian forces occupying parts of Ukraine and not inside Russia itself. And Bloomberg's learned that crypto's Genesis Global Capital may file for bankruptcy as early as this week. The cryptocurrency lending unit of Digital Currency Group has been in talks with various creditor groups amid a liquidity crunch. It is warned that it may need to file for bankruptcy if it fails to raise the cash. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I see elevated services inflation as a symptom of an overheated economy, particularly a tight labor market, which will have to be brought into better balance for the overall inflation rate to return sustainably to 2%.
Laurie Logan there, the Dallas Fed president. The latest Fed speak will continue a little bit later on this afternoon. You will hear from the vice chair, Lael Brainerd. You'll also hear from the New York Fed president, John Williams. So that's the core of the Federal Reserve. The only one missing there is Chairman Powell. A day before the blackout period, the quiet period begins at the Federal Reserve. That's come about quickly, hasn't it? The Federal Reserve decision, just a couple of weeks away, Tom.
It is, and it's after that important data. We made a big deal about inflation, retail sales yesterday. We'll get some data here, John, in 12 minutes, which is important. But I think we've got a clearer understanding that no one has a clue on what the consumer's doing.
Well, after retail
terrible.
sales.
Retail sales was terrible.
It was ugly, yeah.
But United Airlines said, no, it's not.
Don't think so. United's guidance for the quarter of the year ahead, Tom.
Yeah.
Just crushed analyst estimates.
Yeah.
And the move we've seen in those stocks already has been tremendous. So let's talk about the 25 versus 50 just briefly.
Yes, I think we should
It looks
review
like
that.
they're leaning
Yes.
towards 25. Citi jumps on board. They had a call for 50. They've dropped that.
Yeah.
Citi and Andrew Holland-Horst now looking for a 25 basis point hike as well. That seems to be where we're at going into this meeting.
And we're disinflating along the way. Our next guest is going to help us with that. We'll jump into it in 2 seconds. John, I've got to watch this 2-year yield, 4.09%. And I got to be clear that our guest here nailed the movement in the 10-year lower.
Lower, much lower.
Nailed it.
Yesterday, what were we lower by? 18 basis points. It's a real move off the back of that weak data.
Alan Ruskin joins us right now. He's Chief International Strategist for David Folkerts Landau at Deutsche Bank, and we're thrilled that he could join us today. Alan, you absolutely nailed the consequences of lower yields. If the U.S. 2-year on the move to 25 beeps breaks 4% and moves lower, what are the consequences of the outcomes for our listeners and viewers of, say, a 3.7 whatever percent 2-year yield?
Firstly, I think that's being perhaps overly bullish, really. And the bond market's come a long way already. And there are good reasons, I think, to suggest that we're overdue some sort of consolidation at this point. So I wouldn't want to get too excited about, say, a 3.7% 2-year yield. I mean, you're talking about, firstly, Fed funds peaking at somewhere in the region of 4 7/8, which is what the market's at least anticipating. And I don't think that's going to come down. I mean, I think, that's
right.
Really only 2 rate hikes. But I think what's very, very important here is the lower the terminal rate, probably the longer the plateauing period that we see in terms of short-term rates and Fed funds in particular. So that sort of then really acts as a constraint in terms of the downside as far as the 2 years concerned. So I think 4% is probably a bit of a line in the sand as far as the 2 years concerned for the time being.
Alan Ruskin, in Bloomberg Surveillance, we don't keep calls of the year, but we're really aware of people that just magically got the timeline right. Your colleague, Matthew Luzzetti, absolutely nailed a recession, but a recession farther out. Dovetail the Deutsche Bank call on economic dynamics with market and FX analysis. How do you take Luzzetti's great call and fold it into a view for 2023?
Yeah, on the FX side, we've been downplaying to some extent the adjustment and impact that you're seeing from U.S. rates onto the U.S. dollar. We think that last year you went through this perfect storm where rates obviously accelerated the top side and was very, very helpful for the dollar. But it was much more than that. It was a story of Chinese growth weakness. It was a story of the Ukraine war and its impact on energy prices and its impact, therefore, on both the Japan and Euro current account position. All of that is in reverse, really. And so we've tended to emphasize of late, really, just the change in the growth outlook in China, the improvements in the euro balance of payments picture, which actually we just had November current account data in Europe, and it was already improving, in fact, so a little bit surprising there. So the other elements on the other side of the dollar have certainly been helpful in terms of currency appreciation for the euro, the yen, and the yuan. And so the dollar's weakening partly in response to that, and then partly, of course, in response to what we're seeing on the rate side, which is the more obvious element.
Can we just sit on the rate story for a moment? I've been trying to dig into this the last couple of days and no one's biting. But can you go through this for me? We seem to have these two competing forces. Got this reopening story and a better, I stress better, not good, but better situation in Europe, which could potentially drag yields higher. And then we confront potentially a series of weak economic data in the United States, I say potentially, pulling yields lower. What wins out there in that tug of war, do you think, Alan?
Yeah, generally, the U.S. is the dog, and it doesn't get wagged by many other things, other markets as such. It's the stronger force as such. So I would generally focus really on what U.S. fundamentals are doing, what U.S. growth is doing. I think the issue that you have now is that the 10-year yield typically doesn't trade much below sort of 150 basis points below the Fed funds rate. And so Fed funds going to 4 7/8 for any length of time time. The 10-year yield is going to have a hard time much below, say, 3 3/8. And similarly, the 3 3/8 10-year yield, when you think in terms of a equilibrium funds rate of about 2.5%, you don't really typically get a spread that's much lower than that anyway, just in terms of the front-end spread. So I think the constraints, both from the terminal rate side and in terms of the longer-term equilibrium rate, suggest that either you need to get a lower terminal rate, or alternatively, the market needs to flirt with the idea that rates are going well below 2.5% in the cycle when the Fed cuts rates, which typically I think that's not unreasonable to expect, but that's not what's priced in at the moment.
So, Alan, we go into the quiet period after tomorrow with the Federal Reserve. We hear from the Vice Chair today. We hear from the New York Fed President as well. What would you look for from those two speakers before we go into this meeting at the end of this month, the start of February?
Yeah, well, I think the next meeting is now effectively clearly signaled at 25 basis points. That's pretty close to what the market's priced in, so I don't think there needs to be any particular pushback to the next meeting. And really, they don't like signaling much beyond that. I think there can be some discussion about the easing in financial conditions and the fact that this might be maybe too supportive for growth. I think there's a discussion about the idea that the unemployment rate ultimately needs to go up for inflation to head to 2%, that what we have in the works at the moment is inflation perhaps going down to 3% or thereabouts, but to get to 2%, you really need to get a much weaker labor market. So I think that element is where the controversy really lies, and I know where I'd like to see them talk more about.
Alan, awesome, as always. Alan, thank you. Alan Ruskin at Deutsche Bank, jumping on for us on the trading floor over at Deutsche Bank, Tom. The Deutsche Bank Centre, which replaces the
I'm still
Time
not there.
Warner Centre.
Still not there.
Trying to get there too. I'm not there either.
For those of you worldwide, there's an iconic set of two towers at the southwest end of Central Park, the Time Warner Center.
Yeah.
That
Which
was
is
like
now
6 iterations
the
ago.
Deutsche Bank
The Warner Brothers
Center.
Discovery Center, I guess is what we would call it. And for Deutsche Bank to move, I believe, uptown here, which I've heard has really worked out well. There's real plus to that.
If you live on the Upper West Side,
Yeah,
or for that matter, Central Park
it's-
South, it's fantastic.
Yeah.
You can walk.
You can walk.
I'm not sure many other people do. But
We
sure.
haven't. There's sometimes it's like the 59th Street Bridge. It's had like 5 names. It's a 59th Street Bridge.
You just want to stick with that.
Well, Paul
Are you
Simon and
referring to the
Simon
Queensborough
Garfunkel.
Bridge?
Yeah, whatever. Paul Simon
Sure.
and Simon Garfunkel told me it's 59th
That's what
Street
they told
Bridge.
you?
Yeah.
Okay.
You know who they are? Simon,
I do, yeah, of
Garfunkel.
course.
I
know the music.
It's better than Thelma and Louise. Future.
What, I knew who Thelma and Louise were.
I
You
did not. Futures, look at them, John. They just won't give it up. I mean, there's a real deterioration out there. Call it 1%.
What a beautiful partnership this is.
It is.
As we shut this one down, yields are just a little bit higher at 338.
Shut it down. I'm going to keep
In 5
going.
minutes, jobless claims come out. I'm not. I'm going to go to the other studio. Great lineup in the next hour on Bloomberg TV. Michael
Eggs
Contopoulos
Benedict
of Richard Bernstein, Zach Griffiths of Credit Sites, Mano Mahajan
Black
of Edward
coffee, I
Jones,
get Tang.
Michael Nathanson of Moffett-Nathanson. You think I get Eggs Benedict in the other studio?
Contopoulos there is really important. That's an important conversation with
He's
the team
great.
from Richard Bernstein.
And likewise with Michael Nathanson too.
Yeah, he's okay.
Zach's all right as well. With Mona, we need to talk about.
Mona, you know.
Do you remember a year ago everyone said Chinese stocks uninvestable? And now all of a sudden what? What a change. What a difference, I say, a rally makes.
Yeah, enjoy the Eggs Benedict.
Thank you. Some fresh orange juice as well, freshly squeezed
Yeah,
if you want
I don't
to
even-
make the trip over.
John, you should try Tang.
Make the trip over to Casa Ferro.
Bloomberg Surveillance, good morning on radio and television, nationwide and around the world. And we pause now for economic data. And what I'm going to say, folks, this is important. Claims, Thursday claims, we know that. McKee, excellent. Housing starts, building permits, we know that. McKee, excellent. But guess what? I've never said this. The Philadelphia Fed Business Outlook, I am on that. And so is Michael McKee. Here he is right now.
Well, we're just waiting for Philly Fed to drop, but we have got housing starts, and they are worse than last month, but not as bad as anticipated. Down 1.6% during the month of December, 1.4% during the month of September. December building permits are down 1.6%. They'd fallen 11.2%, revised to 10.6% in December. But housing starts were forecast to be down 4.8%. So we are seeing finally maybe some of the higher mortgage rates working their way into new home construction. It's going to be something to follow. It has been strong because builders had a lot of backlogs. We'll see if they're starting to slow down or if that drop was merely weather related. The Philadelphia Fed is out, Tom, and the Philadelphia Fed comes in at negative 8.9. That's an improvement from negative 13.7, which was the December figure. Now, the number everybody wants to see in all of these ISM kind of things is the prices paid index, and prices paid falls to 24.5 from 36.3. The prices received index is 29.9 versus 28.1. So basically, we're getting a much better inflation story in almost every bit of data that we get. Jobless claims. 190,000. I don't even know what to say.
Stop and discuss.
I don't even know what to say.
Seasonally screwed up?
Seasonally screwed up is my guess.
That's official.
190,000 is a crazy low number. It's down from 205 the week before. And it whether it's correct or not, and I don't think it's really telling the exact story. It does say to everyone, no real change in the labor market, and that's going to be something the Fed has to consider here.
I mean, 190 here, I take the 4-week moving average, which is a Bloomberg function, folks, of jobless claims here. But we are, and I've seen the Bloomberg Financial Conditions Index just in the last moment spike up here again. Some people say we're restrictive or sort of near restrictive. And other people are saying, look at the data, we're not restrictive. Which is it?
Well, this is going to be a sharp debate over the next couple of months as the data continues to come in mixed like this, which is kind of what happens when you're in a tightening cycle and the Fed is close to its terminal rate. Jim Bullard the other day saying we're not restrictive yet. Influential but not a voter this year. We will hear from John Williams and Lael Brainerd today.
So what will you listen for from Williams? I'm going to do academics here with Mark Giannini in a minute. But tell me about the academics of John Williams and what a pro like you will listen for today from the gentleman of our star.
Well, he was the first to articulate the idea that Jay Powell glommed onto of sort of like an onion of inflation, and that there are lower levels of inflation.
Now's the cooking part of the show with Julia McKee. Okay, the onion, please.
And so we'll see where he thinks we are in peeling that onion. It's really not a question, I don't think, anymore of 25 versus 50 at this next meeting. They want to be careful as they go forward. 25 seems baked in. Pretty much everybody on the Fed is talking about that. So I wouldn't be surprised if he says 25, but let's see what he says about the terminal rate. And Lael Brainerd, because she's been perhaps the most dovish
in a cumulative
on the
way.
Fed, in a cumulative way, saying we're going to have a lot hitting the economy, and maybe we're starting to see that, and we need to be careful as we go forward. This is going to be the interesting thing.
Very interesting to see here, and of course yields move higher here nicely. 4.11 in the 2-year yield shows the movement of the morning. This is a great honor. We're going to do this, and McKee's going to talk to the outgoing head of the Kansas City Fed here with a real competence of public policy. Mark Giannini joins us right now. He is with Barclays. He's chief U.S. economist, but far more, his academics is entrenched in the debate of the moment. Years ago, a guy named Olivier Blanchard said this 808-page book is a classic. It's the book no one except Giannini has read. It's called Interest in Prices by Michael Woodford. And when you were at Princeton, you were esteemed under Professor Woodford, now up at Columbia, and all that. And it's a knowledge of the underlying theory of what interest and prices do. To people like you, or Ben Bernanke, or Michael Woodford, do you have a theory right now that's operative? Or are you flying blind?
Well, I think good morning, and thank you for having me. No, we think of the framework basically that got described in that textbook and developed in that textbook really underlies a lot of the thinking among monetary policymakers across the world, I would say. People think a lot about the monetary policy through the communications of the Fed and other central banks, through the effects of policy actions longer term as well. I think the forward guidance is a direct implication of the framework developed in the textbook, and that's something that has been used at length by central banks, certainly here in the U.S. and around the world.
Where in the continuum from a COVID shock, a medical disaster, and all the supply side, not supply side, but supply dynamics, back over to traditional Fed theory? Where are we in that timeline right now?
I think we are very much revisiting the more normal dynamics now. There's a lot has been very unusual and very unique with the pandemic. But what we are seeing now is a classic tightness in the labor market, having where labor supply is fairly limited and labor demand is really strong, and that results in substantial wage growth. And the classic tool for policy here is to keep raising interest rates and tighten policy in order to tame that labor market and try to bring the economy on a more sustainable path so that inflation returns back to the 2% target. So I think this dynamic is something that we've seen over time. We've seen certainly back in the 70s and 80s, right. and now the Fed is using those tools again.
The trend of disinflation that we have, and a disinflation coming down with great rapidity, do you at Barclays feel central banks are behind the rate of change of disinflation back to something near normal?
So we do think here that inflation is going to come down pretty quickly, both when we do certainly when we do a bottom-up approach, looking at the individual components of the CPI and the PCE deflator, and also looking at top-down with the tightening in policy that has taken place last year. And that's going to keep having an effect in coming months. So we do see and expect inflation to come down pretty substantially this year and likely below 3% by the end of this year.
The outcome of this off a Phillips curve analysis is, I guess, unemployment migrates from 3.5%, and you would suggest out to 4.5%. I think our viewers and listeners would say that's an abrupt move, where others like James Bullard and Bill Dudley, even Mohamed El-Erian, saying that's normative, that we should see a 1% move in unemployment. What are the consequences to the public of a move from 3.5% to 4.5% unemployment?
Yeah, I think it's going to feel very different by the time we have the economy slowing, as we are seeing some survey data sort of suggesting now, and you pointed out earlier on your show, the retail sales data being pretty weak as well. We expect more weakness coming in. So far, the latest data we've seen is probably more affected by weather as well and other special factors, but we expect more slowing coming in, and the unemployment rate to gradually increase. And we feel like in several months from now, when the unemployment rate is a higher level, together with inflation also coming down and wage growth moderating somewhat, is going to feel a lot different. And in particular, if rates are at a higher level, short-term rates probably going up another 25 basis point at this meeting, and then followed by another 25 basis point in March, and is going to bring a very different constellation of macro factors.
You know, I find what's fascinating here, and folks just joining us here on radio and television, Mark Giannani with us with Barclays, with this wonderful dovetail of academics into market economics as well. The sum of all our fears right now, Dr. Giannani, what's your biggest mystery for 2023? Not so much the doom and gloom of your biggest fear, but what's the unknown as you synthesize last year's debacle in the markets? What's your unknown right now?
Well, geopolitical issues is always some very big source of concern, I would say. But I do think something that appears unusual now is really this labor market that continues to roar back, and signal after signal that comes out from the labor market, including this morning's jobless claim, suggests really a labor market that keeps roaring ahead, and how does that really line up with the overall economic activity slowing? So I think there are a number of factors that are new here and that are emerging and that are no.
Well, Dr. Giannotti, thank you so much for joining us with Barclays. Thrilled their chief U.S. economist could join us this morning. A little bit of an academic exercise there, but I thought we could move to something different than the debate of 25 to 50 beeps. And as John Ferro mentioned earlier, this morning on Market Economics, Citigroup comes in with an adjustment from a 50 beep call coming down to 25 beeps, 0.25% move there by Citigroup. Futures are negative 32, Dow futures negative 263. I see that looking at the Morgan Stanley billboard outside their office here in Midtown Manhattan, which means in Davos, Switzerland, are David Weston with their leader, James Gorman. David?
Thank you so much, Tom. Well, I'm here with your co-anchor, Lisa Abramowicz, and we do indeed have James Gorman, the chair and CEO of Morgan Stanley. So, James, thanks so much for joining us here in Davos. Your earnings came out. Everybody pay attention to them. And I heard a story, you can tell me it's true or not, that once some time ago, you were recruiting a senior executive and said, you know, wealth management may not be as exciting, but over time you do better, more steady. Is that what we saw? I noticed your stock went up 6% when Goldman's went down 6% the same day.
Well, firstly, thanks for having us. You know, it was a good day because I told our board a couple of years ago what I'd really like to see, selfishly, is a very difficult environment. I don't want to see it for the country. I mean, it's not fair, but for Morgan Stanley, because I wanted to prove the business model would do fine when things are really difficult. And in fact, we had our second best year ever in revenues and net income, third best in EPS. In our history. So, you know, what it proved was the volatility of the markets business, everybody understands. The volatility of underwriting, IPOs are not happening when things are very uncertain, trading and the like. But what we proved is by having, you know, between $5 and $6 trillion of people's money under management, that is stable. And that was the design 12 years ago, and we've got there.
One thing that you said was you are planning to expand some of the wealth management aspect, even as you cut back other parts of the business. You acquired E-Trade, Eaton Vance. Is there another acquisition that you're trying to target, or is it going to be just sort of organic growth?
No, I think it's a mix of both. I mean, we started off with Smith Barney 14 years ago. Then we acquired a wonderful little company in Calgary, Canada, called Solium, which did all the sort of workplace stock plan businesses for a lot of the S&P companies. Then we bought E-Trade, then we bought Eaton Vance, and we bought Mesa West, which is another company. So we've been building them, and as opportunities come up, we keep acquiring in those spaces.
Is there room for another large acquisition?
There's always room, but we like things that aren't balance sheet intensive. We like things that help grow scale in spaces that we understand. And, you know, we like things when we know what the capital picture looks like. So, you know, at the moment, we've been quite aggressive with our buyback. We doubled our dividend 2 years ago. We increased it 11% last year. But we're also dealing with changing regulatory environment. So you're managing between what are the capital demands regulators require, how do you distribute it through dividends and through buybacks, and then what do you need to do to invest in the business? And part of that investment, of course, is acquisition. So it's a multi sort of chess game that we're playing.
James, you said it was there were some difficulties, and you were happy that you could manage through those difficulties and show that your model works. Some of the difficulties were some highly leveraged loans for some acquisitions and things like that. Yeah. Is that crimping your ability going forward to make some of those highly leveraged loans? Are you changing the risk calculus?
No, we've been, I would say, erred conservative over the last 2 years. In fact, it was September a year and a half ago, that I met with the management committee and said, let's all just pull it in 5-10%, right? And our RWAs, our risk-weighted assets, actually declined at the end of the year. So we did that. And so within the leveraged loan space, again, erred a little conservative, but we have a large portfolio. Obviously, you're going to take some losses in these markets within that. They're absorbed in our numbers, but you're also generating a lot of interest income, a lot of fees on it. So in balance, David, I think we're reasonably well positioned, but we're definitely not trying to be aggressive in this environment.
There is one high-profile loan that might rhyme with Twitter, that we're going to have to talk about. The Twitter loan that I know Morgan Stanley led on. Could Morgan Stanley end up owning Twitter?
Could Morgan, I've never been asked that question. No, we could not end up owning Twitter.
Well, do you plan on offloading those loans, or do you just plan to hold them?
Firstly, Twitter's a great company, and let's be fair, Elon Musk is one of the greatest entrepreneurs and business people, in the last century, and that's not an exaggeration. Look what he did. Just take the Boring Company alone, let alone SpaceX, let alone Tesla. I mean, this person has extraordinary capabilities. Twitter is a great company. Obviously, it's gone through a restructuring. It's part of our. I'm not going to talk about the specific loan position we have, but we're very comfortable with that position.
So there are a lot of things we don't know about the economy going forward. One thing that people seem to be reasonably confident is the rates are going to be higher. Interest rates are going to be higher than they have been in the past. How does that basic fact change your business? How do you manage your business differently when you've got rates at 4, 5, 6% instead of 0 to 0.5%?
Well, we had an artificial environment. I remember when I came to the United States. I mean, obviously, as an unsecured student, I wasn't a great credit, and the bank loan reflected it. I paid 24%. My first mortgage was 14.5%. So we've lived in a surreal world for a decade, which is the legacy of the financial crisis. To get the economy back to where it was, central governments around the world kept rates near zero. Then along came COVID, which delayed what would have been a natural rise in rates globally. Then along came the Russian invasion of Ukraine, which further delayed it. Finally, you turn the corner in 2022, mid-22, when the Federal Reserve and other central banks around the world, not by coordination, just by need, had to normalize rates back to neutral. They've gone higher than that. They had to go higher in order to take some of the fluff out of the economy. So I see it as sort of a natural consequence. I don't think of it as particularly alarming.
A natural consequence, but which parts of Morgan Stanley's business are hurt by higher rates and which are helped by higher rates?
Well, we benefit in net interest income in the wealth business. We manage over $300 billion of deposits. Rate volatility obviously helps your macro trading businesses in foreign exchange and rates. It hurts companies wanting to do deals because the cost of financing is higher. It hurts your margin loan business. People bring down their margin loans because it's more expensive. So there are gives and gets, if you will. But what I loved about the performance of the business last year, which again wasn't a record, but was a great year, was that with those gives and gets, we came out in a position of 15% ROTCE and attracted over $300 billion of new money from clients.
Here at Davos, there seems to be an incredible amount of optimism, and people have noted the shift in tone and that suddenly things seem to be moving around the corner. And I had asked you, do you think it's overplayed? You said you're the most optimistic person you know. So why are you so optimistic? What does optimistic look like here?
Well, I've seen a lot of cycles in my career, and I've seen some really, really dark periods. The financial crisis after September 11. Even though, the early recessions in the US in 93, 94, the market bust in 87, I go back, I'm a lot older than you, I go back a long way. And, I think what we've been through, if you stack up the negative stuff that happened, first land war in Europe in 40 years, first global pandemic in a century, first land war in Europe in 70 years, first global pandemic in a century, and highest rate increase because of inflation in 40 years, that's a lot to throw at people. And where are we now? It's not bad. The debate is, will it be a recession? Will it be short and shallow? Nobody's saying we go into depression, right? Everybody's saying we can kind of deal with this. And two things I think have changed in the last month, which has caused this echo chamber we live in here in Davos, where everybody's basically repeating back to each other what they've heard from the last person. Let's be honest. I'm not, hopefully, but most people are. Two things have changed. Number one, the inflation numbers are there's clear evidence inflation has in fact peaked and is coming down, right? How quickly, whether the Fed will get us to 2% and when, remains the debate. But is clearly the slope of the line is positive, is to everybody's favor. And the second is not just the opening up of China, but China has embraced the rest of the world more aggressively in the last few weeks, witnessed by the Vice Premier meeting with Treasury Secretary Yellen this morning, I think it was this morning, in a way that we haven't seen for some time. So the big question coming out of the Party Congress and President Xi, being re-elected by the Congress, was where does China go from here? Does common prosperity mean effectively dividing the pie up so everybody gets a piece of it, or by growing the pie? And what we're seeing is the tilt is now from divide the pie to grow the pie.
Does that mean you've got more confidence to expand in China?
We've got a very good business in Greater China. Obviously, we have a huge business in Hong Kong, and we continue to have, I think, on the mainland up to 1,000 people in various functions. But no, I think we need to see a little more clarity of Chinese policy, a little more, sober discussion around global trade relations. Right now, I think we're certainly in a watch, but tilting more positive than we would have been 3-6 months ago.
We've come all the way over to Switzerland. I'm struck, at least, by the fact that there's all talk about Washington, particularly the debt ceiling. A lot of concern. I hear two things. One is it's ridiculous, and two is it would be catastrophic. What is your reaction to debt ceiling? How do you take into account the possibility of a U.S. default?
Well, was it Churchill who said the Americans eventually get it right after, I can't remember the exact quote.
Trying alternative.
Yeah, so, I'm confident that politics will finally get to the right place on this. I'm confident about that. Because the other option is just not an option.
One thing at Davos that people have also been talking about is the new normal for work from home. We heard a bit of a retracement from Citigroup in an interview that David did here with Jane Fraser. What's the new normal? Is it coming into the office 4 days a week? Is it flexible? Is it work from home more freely?
I think it's very, very specific to what you do. If you're a tax attorney who doesn't work with other teams, then obviously you can spend a lot more time by yourself. Doesn't matter if you're in an office or not. I mean, there are different kinds of jobs is where I'd start with. The main point is, post-COVID, we learned you can function. I ran Morgan Stanley for 3 months from my home office, right, with 73,000 people. So it's pretty remarkable. We proved you actually can do it by not going into the office. But should you do it by not going to the office? Now, that clearly, to me, the big answer to that is no. We won't put the genie back in the bottle. 5 days in the office for everybody is not going to happen again. For some people, of course. And at Morgan Stanley, we're kind of business unit by business unit. It's 3 or 4 days in the office. My rule has always been on this. If you're not spending a majority of your working time in the company of your colleagues, you are missing out on mentorship, on development, on EQ, on just reading the signals of being in a meeting and watch how people, handle the stresses that go on and the unspoken body language and so on. So it's 3 or 4 days a week. I don't think that changes in a hurry. Some people in some businesses, our trading floors are cheek to jowl. You go in there, they're 5 days a week. So it's very business specific. But my golden rule is don't put the genie back in the bottle. You can't. On the other hand, this is not an employee choice. They don't get to choose their compensation. They don't get to choose their promotion. They don't get to choose to stay home 5 days a week. I want them with other employees at least 3 or 4 days.
So, James, you've talked about some of the responsibilities of the CEO, which are formidable, allocating capital, making sure you're right there. People sitting around corners. One of the jobs is succession for every good CEO. And we've seen it done well. We've seen it done not so well. A couple of years ago, you said maybe 3 more years. How do you approach the question of succession? How do you set it up for the good of the institution of Morgan Stanley?
Very intentionally. Firstly, you should always have a sort of an envelope for, God forbid, something horrible happens. We've done that from a very first board meeting in January of 2010. But more realistically, you plan a generation of people who can take over. We at Morgan Stanley have now 3 executives who can replace me. They're all very, very talented executives, and we're trying to fill out their skill base, and ultimately the board will decide who is the best qualified to run our particular company at this point in time. I'm extremely intentional about it. I would definitely step down. I'm not going to stay in this job for life. I have no interest in that. And it's unhealthy for the way we're constructed, right? We've got to focus on what's right for Morgan Stanley, and it's to grow the next generation. I work on a 10-year and 20-year plan in talent planning. And that's how far out I'm thinking about it. And, I've been in this job, this is my 14th year, so I've had plenty of opportunity to develop folks. And the great news is, David, we've got some unbelievable talent.
James Gorman, thank you so much for being with us, the head of Morgan Stanley. Tom, back to you.
Lisa Abramowicz, thanks so much. I noticed there with the really interesting comments from Mr. Gorman on work from home that Bramo this week is WFD. She is very work from Davos. And we'll have continued reports here through the end of the week. I should point out David Weston with Wall Street Week. Look for that, a special edition coming from Davos, Switzerland. We'll do that, I believe, tomorrow as well. The world's changed. There was economic data. I've looked at a couple notes while we were listening to Mr. Gorman. Ian Lingen really frames out how unusual claims are. Anyone that tells you they understand initial jobless claims in the United States of America, run as fast as you can, hopefully holding on to your wallet. 190,000 on claims. That is absolutely stunning coming out of this pandemic. Please stay with us through the day. Futures fractionally improved, marginally at a negative 28 on futures of VIX 21.48. This is Bloomberg Surveillance.